where's all the strength coming from in this economy? I mean, do we just still have liquidity in our system from COVID? How do we keep beating all these expectations?
Yeah, I mean, the U.S. economy has just proved incredibly resilient to that very aggressive rate tightening cycle. We saw it again just today with that jobs number. I think the labor market especially remains a real bright spot in the economy. And all of these, hot data prints that keep coming in just showcase the continued strength of the U.S. economy and the labor market in particular. And despite all that economic uncertainty that's going around, demand has really held up, and firms, for the most part, are keeping people on. And the vast majority of Americans who want a job right now can get a job.
Any idea what could bring it to a halt? I mean, if one of the fastest rate hiking regimes in history didn't do it, there's always this talk about lagged effects, and everybody's worried about what the lagged effects are. I mean, should we put that to the side now? Like that maybe we saw the effects in some of the road speed bumps and roadblocks we hit over the last year that didn't break us? I mean, there were some moments of stress there, but should we be thinking that there is some big shoe about to drop?
Yeah, so those lagged effects are still coming. I think if you had asked anybody a couple of years ago, where the economy would be at this point after the Fed had raised rates as much as they had, they wouldn't expect, the robustness and strength of growth that we've seen. However, a lot of the impact of those rates is still coming. We've seen, Fed officials come out and talk about those big increases in the yields that you guys were just talking about on the previous segment, and those are all going to have an impact on borrowing costs for firms. So if you're looking around and you're seeing all this economic uncertainty, but now it's costing you a lot more to borrow the money to expand your firm or increase inventory or maybe hire some more workers, then increasingly we may start to see decision makers start to lean on the side of caution. We're not seeing it yet, but those effects are lagged, and I think we're still going to continue to see that impact. And you couple that with those mounting economic uncertainty and the headwinds from externally, geopolitical risk, Europe on the cusp of recession, or what's going on in Washington, D.C. with the fiscal situation, then we will have some cause for concern.
Some of those things kind of exogenous, maybe not black swan, but not really under our control necessarily when it comes to the political situation here or abroad with geopolitics. If we kind of hold all things equal, is there any reason to expect that we're approaching some deep cliff? I mean, there are still some concerns around some of the bank deposits that we heard from in earnings, but as long as there's not a massive liquidity event, they shouldn't have to tap into those unrealized losses. I mean, is there anything that looks like an obvious landmine to you guys?
I mean, the economy is still chugging along. The job market is very strong, and you kind of build up from there. Real wage growth is positive. So a lot of talk about, the drawdown and excess savings would eventually deplete a U.S. consumer, and we would see demand collapse. I think now with, while there's still some strength to that argument, the fact that real wage growth is now positive and incomes are rising from a purchasing power perspective means that that consumer demand is now more sustainable. So, barring the myriad of risk that we see out there, I think the U.S. economy continues to chug along for now. Business cycles do inevitably end, but it's hard to see, at least in the super near term, what might cause it to really kind of switch off rapidly.
Yeah, okay. Well said. When you look at wages, let's go back to that subject for a moment, because prior to earnings and prior to the Middle East flare-up, the main story we were focused on was labor and strikes and unionization and across sectors too. Is there still more of that to come with the jobs in the economy this strong? Does that empower the worker to continue pressing for higher wages?
I think so. The job market's still super tight. I think workers are feeling strengthening bargaining power. Here at Morning Consult, we're serving thousands of workers every day here, and our data is showing that workers are feeling like they have increasing bargaining power. And we've seen the share that say their employer would provide a raise if they asked or match a higher external offer, notably increasing over the course of the year. And we're seeing this play out in action with those the UAW strikes, of course, and then also in the healthcare industry in California. And workers are starting to flex their muscle. So looking around for kind of some softer data points, I think the Fed would have taken solace in the fact that nominal wage growth has been cooling. But if workers are out here flexing their muscle, demanding higher pay, then we're gonna that would support wage pressures. So that's been a positive for now for workers and for workers at the Fed as inflation cools. But yeah, workers are certainly flexing their muscles.
All right, Jesse, thanks for the analysis. Definitely confidence building here, the commentary and the data. Appreciate it very much.
Thank you.
Jesse Wheeler, Senior Economist of the Morning Consult. All right, when we come back, let's open up that bell and see how we do today. We'll stick around. See you in a moment.
Good morning. It's October 19th. Profit Thirsty Thursday. We're going to be watching the SPY today, watching the stock market, GME, AMC, GNS, whatever. Thank you for being here. Hope you had a good evening. Had a good morning. We've got Jerome Powell today as well. Decent volatility. Indeed. Sub up, like up, comment down. Happy money sticks around. Follow us on Twitter at HappyMoneyYT. And we have a Discord server link for those, are both in the description. Market's going to be open in about 2 minutes. I'm actually going to review yesterday's trades this morning, since I didn't do it yesterday. I think that'll help keep it more fresh for today. Morning, Mohammed. Barbecue we got? No, not yet, not necessarily. Could be some sort of new equity still coming for you if you're holding barbecue. Some of the stuff I've seen looks like still, yeah, there's if it was gone, it'd be gone. I've heard different wording from different brokerages, making it seem like something else is going on behind the scenes. So it'd be pretty simple if it was just canceled or deleted or whatever, but it seems like it's not just that. So anything other than that, and should have some value there, I'd imagine. Okay, let me see. Yeah, yesterday broke the streak. It did it in such an ugly fashion. That's the thing. Like, I'm fine to have but I guess don't always get a nice red day. Look at the red day you wanted, you get ugly one. We can make it back. Yeah, I broke some rules yesterday, ended up just kind of, I guess, not doing stop losses. And then not fully getting out when I had a couple opportunities. Like here I had a chance, and then here just didn't get out enough because I thought it was still a good trade, and it would have been, but we were in such a chop that it just, on the longer time frame, we'd already done the inverse cup and handle, which I was even talking about in the morning, but then forgot about later in the day just because of all that chop. Here's the cup, and then that handle just broke it. So anyways, let's go over the trades and see. It's going to be hard because you can't tell where I was green and red on the day. I kind of remember, but I didn't have time to look. It happened fast, and my brokerage is slow. So Another issue with what I shouldn't have been battling. Just taking small loss or even, or I mean, I was up at some point too. 15. Okay, so inputs at. This is weird doing it the next day. It does not tell me the time. Doesn't tell me the time. Huh. Weird. Market just opened. I'll be kind of chill this morning. Let it set up. I'm gonna review this. I can. Doesn't tell me the time the next day. These Fidelity's charging me 65 cents a contract. That's bad. Okay, well, can't see the times. This is doesn't tell me the times. Can't do it. Dang it. Oh, here we are. Stick to stop losses. Only go for the best trades. Don't overtrade. Those things were all kind of slipping yesterday. Problem with yesterday's red day is that it turned green. I started green, then turned red, and then I got back green. And I didn't cut enough. I went red, and then I went green again. I didn't cut enough. And this just whipsawing, and I was averaging into stuff, and then that started to kill me. And then I was basically just gambling by averaging in when there wasn't confirmation of any moves that I wanted. I just trying to force it. Never good. So being a big red day is what sucked, especially because I had multiple exits. And I knew it was choppy, so. But when we had those rallies, I thought we were breaking out of the chop. Not so much. Alright, GME is down 1%, SPY is up 0.18. We did have initial jobless claims this morning. And Philly Fed Manufacturing, both at 8:30. Right here. And then today we have Powell at 12. US leading economic indicators at 10. Thanks for being here. Morning, Guts. Thanks, sir. AT&T have earnings? 6.5% on this thing? Yeah, wow. Big move for AT&T. Express is up. Redfin. Alright, let's buy. Netflix up on earnings. Ads up 8. ATP 6.5. Durka up 5.6. Ala up 5.2. American Airlines, Cosmo. So, wondering if I should have started scaling into those SPY puts a little bit. Today could be the catalyst for us to rally just a little more. A lot of Fed speakers after Powell also, Goolsbee, Barr. It's fine to be patient on those. Alright, send a message out to the Theta Farm members. Closing out of a position. Small profits. Coffee. Got another one. GME down almost 2. It's at 1358. Netflix still rallying, man. I think. Oh, never mind. That was up more. $45. GME down 2.3 now. AMC back to break even. Green. I'm back up to BWAP. GNS is down 3 1/4. New low there on SPY. Grabbing some calls there. week, I hope. I can't do market orders now. Does the account drop back below 25k? I think when it went over 25k, it automatically flipped me to margin account. Why? I can market close them. Doing everything they can to keep me from making money. Okay, cool. I can market close them at least. It'll probably be pretty mellow until Powell this morning, I'm assuming. Perhaps a bit choppy. Or GME's down 2.3, 13.5. He's up 0.8. LVS is up 4. They have earnings? They might have. Rad's up 11. Netflix still hanging on 15.5. Back to VWAP, doing the VWAP chop. Still doing the VWAP chop. Got a little inverse head and shoulders down here. Break the channel. Building some liquidity. And it could be very, very slow until J Powell. Copy. You know how the market likes to be bullish though when J Powell's about to talk. Might get a little J Powell run up at some point. Like 11:45. Just back to chopping. Little VWAP here. Rum's looked pretty bad for a while. Let's look. Yeah. So I want to see it break this resistance here. Break here, you might see let's see, we've got 580 for resistance, 630, 68. But if it can't, then you're just still in this channel, just bear flagging down here. The market's choppy for sure. I jumped out of those calls. Wait. thing, JT. GME down 2.5. 13.49. AMC's up 1%. Wondering if AMC's rips are done like it used to have with this all this dilution they just had. Just flooded the market with shares. Even if there's a high short interest, there's so many shares out there floating around. No problem. This is going to be annoying. Only limit order. That's outrageous, man. I need to send money out of this brokerage. Stop trading on here. Not send money out of here? Oh, is it gonna break? Break. Probably not gonna get filled. Maybe this is good. Cancel that. I can't trade like this. It's insane. AMC's up 3%. I'm still chopping around. Just above VWAP. See if you can test high day, make a little cup here. Try to get some money out of it. Fidelity. There's your chop. Whew. Wants to, but Three to 5 days. Where? Gotta wait. Dude, look at that crap. Ugly. Wow, AMC's up 4.5 now. Rip rally. Spy, holy chop. Netflix. Back up to the high, 16.6. E. Up 7. GME down 2.5. New low there.
damning element of this?
You know, a lot of people talk about the margin compression from the declining prices, which, shocker, we lower our price, we make less money. And the Cybertruck, but really at the end of the day, I mean, Tesla's Elon, and he really, there was just nothing there in the call where, you were kind of sitting there like, all right, the numbers weren't great, but, Elon's going to come on and he's going to say something, and just nothing really there, just kind of blah.
Here's the case that I would argue is that the margin getting shredded is obviously not a great thing financially, but people are going to buy cars, don't think cars are going anywhere, and their gross margin, which dropped down to 18%, still above Ford by a long shot, whose last earnings did like 8% gross margin, and then GM, which was around 17%, and that was for the last quarter. My guess is both their margins are going to drop substantially as well. So, I mean, if Tesla undercuts the competition by dropping their prices, it can still achieve a margin that's better. I mean, Rivian, Fisker, forget about it. They lose like tens of thousands of dollars on each car, if not more. So, I mean, who's the competition, though, Matt, both from a scale, volume, and a financial standpoint?
Yeah, and, I'm a trader, so I think short term. But long term, yeah, nobody. I mean, Tesla dominates this market. They're going to continue to. People want EVs, and, most of those other companies are money losers. They lose a ton on every single car they sell. So longer term, yeah, I mean, I may look at this weakness as a buying opportunity. As a trader, I'm watching the 200-day moving average, which, is still far away, but not that far at the moment. And, seeing if we get some support there that might be viable, or if it blows through it, maybe you see a decline like we saw, at the end of last year. I think we'll need to see some real more market weakness for that, but, we got a war going on, so you never know.
Okay, so you don't hate it, but you need to see some technical support show up. I hear that. I mean, at the end of the day, the price is the price, and I've got a line on the chart that broke pretty hard overnight, so there is that for sure. As far as the Cybertruck goes, do you think this thing's going to be a big success? Is it going to be a big flop? Is it just going to be, not that exciting? Where do you stand?
I think it looks really, really weird, but I'm not going to bet against Elon. People don't make money betting against Elon, so I mean, I wouldn't buy it, but I would never bet against Elon. So I would have to say I think it'll be a success. Okay,
and I guess we're going to find out soon, because apparently they say it will be coming out this year. Where does Tesla fit into your funds, Matt? Is it a big position in any of your ETFs right now?
Well, today we just launched the only 2x long and the only 2x short Tesla. So yeah, it is a big part. We're also shorted in SGM, because that's a
little flush on SPY breaking out of that channel.
A Kramer thing. So, we just launched TSLT, which is the long, and TSLZ, which is the short.
Okay, so, and this is
inverse Kramer.
2X,
is that one too?
Right. So
the ones we launched are 2x, right? The one you've got on the screen is only a 1x.
Right. That's the single stock ETF we talked about before. So now you can get a little leverage on
single
it with the 2X.
stock ETF.
Now we can give you a little leverage.
All right. How is the single stock ETF reception so far? You've had some time to assess it. Are people using it?
Yeah, I mean, there's about 1.4, 1.5 billion total in single stocks right now. So, we also just launched 2x long short NVIDIA, because those are the two big ones, and wouldn't be shocked if we do some others. There are no 2x single stocks out there. So these have the most leverage of anything that there is. And, you know, now that we've broken that 2x barrier, wouldn't be shocked if we do some more.
All right. Thanks for the heads up. And folks sure like high beta action if they're in Tesla. So I wouldn't be surprised if they want to juice it up even more with the 2x. Matt, thanks for jumping on with us. Total Capital Management.
That same pattern from yesterday, I feel like.
Let's talk some food.
Just that crazy rip.
Chipotle, Domino's,
Bears building
and
liquidity.
McDonald's. So I'm using the term restaurant.
We're taking puts on the break of that
loosely.
channel, but
There's fast
I
casual,
like
there's
that.
fast food, there's delivery. You're getting food from all of them. So we'll be right back. We'll take a look at the
30.
technicals.
Whoa, there's a more fleshy flush on SPY. Down a quarter now. GME down 3.3. He's up 2.5. Rite Aid's up 43. Those are on SPY.
Over the next several years, so they still see this name as relatively stable. They've had some reevaluating with their franchise fees, which I know has caused some pushback from these franchise owners, but all in all, a name that is consistently stable, especially in times of some pressure on the overall market because of their low prices and their commitment to that.
That's kind of what I was wondering, if the bounce we're getting maybe happens as the macro, but I don't know. We got to be careful with that, to your point. I mean, sold off along with a bunch of other food companies and snack businesses. Maybe it got Ozempic a little bit there. But this is kind of one of those, it's not a fake note, but it's like kind of dramatic, and the price started cut and the expectations cut, but then it's still
nothing
super
but
bullish.
positive. Yeah.
Yeah, so all right, because I was kind of wondering, all right, why is the stock up even with all this negativity? But they still believe it has a good bit of ways to run here, Rick. It seems like the chart has a gravitational pull around like $260.
Yeah, that is an area that definitely caught my eye here because we saw first this gap up there that's about the pre-gap highs. We bottomed out there numerous times then around that same area. Then if you'll give me a little artistic license here, we basically formed the golden arches here. The M here. Kind of this not a great pattern for the bulls though, because
what?
Well, look
Golden Arch
here.
is not bullish for McDonald's, Rick. Artistic license removed.
I know, but we topped out many times here right around the 300 level. So that suggests that we had declining enthusiasm there for this stock. The bulls weren't able to push it above that key threshold there. Not really the greatest price pattern here, despite it matching up with our corporate logo there. So then we had another shoe drop here. We had our lows near 280. Once we broke below that, the downtrend really accelerated here. You can see we had a more gradual downtrend in blue, then a very steep downtrend in white there. We broke out to the upside though, and today we hit that same point, that 260 level, and we faltered a little bit. We are above the 21-day exponential moving average though. Our moving average is starting to turn upward here, but overall we are below our two longer-term moving averages, which are trending down here. The trend is still down, but possibly starting to reverse here. It would really help the bulls, I think, in terms of confirmatory evidence if the RSI, our measure of momentum, was to cross above that 50 midline and push into the bullish momentum territory. At the same time, we broke above that resistance point here. So as I said, 260 point to watch to the upside. If we do start moving further beyond that point, we've got our volume profile point of control near about 268 or so. To the downside, it's the old lows. The point here near about 246, that's really the mark to watch for further downside.
Okay, I think they got Ozempic right here.
It's possible.
Because that does kind of fit. But this is a pretty nice multi-day bounce. I mean, 5 straight days higher. We got to go back to this little punch upward here, basically, to get that streak. So it's also just something that doesn't happen a ton here in the last couple months. So a decent little bounce for McDonald's and up 1% this morning, despite a down market and some reduced expectations from a bullish analyst. Let's talk Chipotle. As CMG is the do no wrong stock of like the COVID era, and earnings always generally feel like they send this thing higher, Jenny. But I don't know, maybe Ozempic can kill our Chipotle cravings too? I don't think so.
Okay, so I have to say, I disagree with this whole Ozempic effect being to blame for all this weakness in restaurant and food stocks, because think about it, McDonald's serves a more, I would say, well-rounded consumer because of their low price points. McDonald's is notoriously cheap. But what we know is Ozempic, it's $1,000 a month. So that's a different customer. I mean, that's not serving the American people when it's $1,000 a month. I don't subscribe to that at all.
Well-rounded McDonald's customer.
That was not intentional. But so Chipotle, Deutsche Bank, starting coverage.
Yeah, Tesla did sell off. They didn't like that earnings call.
$2,000, $375 price target. Calling Chipotle this rare
saying more on a
compounding
long-term
growth
basis,
story
not
as it's well positioned for sustainable
earnings.
mid-single-digit growth plus same-store sales growth, as well as unit acceleration
It's
and margin
still in
expansion.
that range
They
too.
said, given the belief the company's multifaceted sales strategy will continue to deliver
is
these
a big amount
positive
for Tesla to go
traffic
down
trends
is
and increasing
telling.
visibility to the path of high 20% in restaurant margins. They believe that shares now offer this favorable risk and reward. But Chipotle has not been immune to the pullback we've seen. I mean, Chipotle shares were also ripping higher. They gapped down in a very ugly way on their last earnings. So we do know this name moves, and it moves with conviction.
All right. I liked the movement on that B-roll there through the Chipotle store. I could literally smell it.
I know, it like makes me hungry every time.
B-roll. Yeah, I know. I can taste it in the air from that visual. All right. So Rick, it did fall apart to Jenny's point, the gap down from the highs, but it has held the level from the last earnings for the most part.
Stop dreaming of barbacoa. We got charts to focus on.
How'd you know that's my go-to?
I just know. I can just tell. But, you know, I think I would be a little skeptical at the Ozempic thing too here. But, you know, looking at the charts, downward kind of falling wedge type shape here, starting with those highs right around here near 2175 or so. A little bit of a minor breakout here today, kind of like McDonald's. We are seeing a similar move upward. This one is just starting though, so we'll have to see if it has some legs here. It's looking rather promising, I would say. We're crossing above our yellow 21-day EMA. The moving averages themselves starting to flatten out, going from sloping downward to sloping sideways more. So the trend is starting to improve a little bit here. We can also see that we have some clearly defined levels to watch here. 18, 17, and right here was the highs before we had that big gap upward here. That was a bit of a question mark here. We were crossing below it, bouncing around it back and forth here. We even crossed below our purple 252-day EMA as well, you can see there. So it's kind of dicey for a couple days, but we've managed to make our way back upward across the moving average, across the resistance, and then across our 21-day EMA today here. One other problem, I would say, though, we're not quite crossing above that midline on the RSI. The bulls would really want to see a cross above resistance and a cross above the midline at the same time. That would be bullish confirmation here of further upside activity potentially. So if we were to keep going upward, 63-day EMA is the first point that seems obvious on the chart here, near about 1890 or so. But then 1970 really caught my eye as well, because it's about where we topped out twice. So we'd really want to move beyond that point to continue some kind of uptrend here. To the downside, same level I highlighted here, this kind of confluence between the pre-gap highs and our 252-day EMA. We could even see a retest of this old downward sloping trend line here. So that's the area to watch to the downside.
Okay. If Chipotle breaks down, then we know we've got problems in this sector, because just earnings almost always live up to expectations for this company. But it is some real breakage in the chart that's been consistent now for a couple months that we haven't seen in a while. So one to certainly keep an eye on. All right, last, we saved your favorite for last, Jenny. DPZ, Domino's with the Uber combo.
AMC at 4.3.
Has been a pretty big story for this company. Is the analyst talking about that at all?
Still
I mean,
under
a
$1
little
pre-split.
bit, this is still the worst rated of these three by a lot. So I will say, even though it's my favorite to consume, I can understand that this is the least liked by analysts and by a mile. I mean, they have less than a 50% buy rating ratio, which is pretty bad for a company of their size.
They just got, like a month ago, they're at 52-week highs.
Yeah, but I just feel like they've lost a little bit of their enthusiasm. I mean, so is everything, I guess. But right now it feels like we're seeing this pullback, and they've yet to really excite investors. Deutsche Bank today, buy rating, $430 price target, saying that Domino's does offer a favorable setup into third quarter and 2024, supported by accelerating same-store sales growth, accelerating unit growth, and margin expansion. They also did say they're encouraged by the company's overall increasing efforts to reaccelerate its growth following a couple of years of what has been a lackluster strategy. They believe now that current estimates appear achievable. So I think it's really interesting you mentioned the Uber Eats partnership, because that was notoriously what they were avidly against, where they were like, we're not going to partner with these third-party delivery services.
Yeah, do it all on
we
their
have
own.
our own tracker. Remember, we were saying at one point Domino's was valued like a tech company almost.
Yeah,
that is no longer the
for sure.
case, because I don't feel like their technology has been able to keep up. But I think right now expanding their sort of customer base, getting on these third-party apps is key, because you have, say, someone like me that's a routine order, but how do you get someone like you that's never ordered before?
It's never going to happen.
Well, that's a terrible thing to say. Never gonna happen?
You know, I go on Uber Eats or Grubhub or wherever, there's a bunch of much better pizza for not that much more. Okay, but however, I am with you that, like, their whole value proposition that drove the stock to insane heights for like a decade, them partnering with Uber is kind of an admission that, like, that ran out of juice.
Totally.
If you can't beat them, join them.
The tracker to me is now like the most obsolete. It's like technology of 10 years ago.
Right. That's true. College, different story, though. I'm all about the Domino's scene. Okay. Full reversal of that big gap up on the Uber news, Rick. So, I mean, we've looked at this a few times on this segment. What's new?
Yeah, I mean, 11% gap up. We've given it all back and more from that point. You can see here 350 was the point where we started the gap up here, but no, really a big slide from there. Downward sloping trend line here. Below all three of our major moving averages. Our two shorter term ones are trending downward. Our purple 252-day, at best, I would say, is sideways. It's starting to slant a little downward as well here. The faster ones are crossing below the slower ones as well. So overall, you know, a downtrend in full effect here. And this 350 level was difficult for traders the past few days here. We've struggled around that area. We hit it yesterday and today, but we were rejected pretty firmly at that point here. So kind of a tough situation. RSI, I thought, was also very interesting here, because we have matching trend lines. We have a downward sloping trend line for price and a downward sloping trend line in the RSI. But we broke beyond the trend line in the RSI. We did not get a big breakout or any kind of big push upward, though. We were kind of just drifting sideways here. So it suggests that perhaps this downtrend could be getting a little long in the tooth. Maybe we'll see a bit of a bounce here, but we're not really seeing it match price yet. So what we'd want to see would be a big push upward above this resistance, and then some additional follow through with the RSI here. Price levels to watch. A lot of horizontal levels looked pretty important to me, namely 350. That's the key one right here. If we were to keep moving to the upside, we've got a nice little confluence here. We've got our 252-day EMA, our 21-day EMA, and our trend line all converging near about the 361 level or so. So that's a key point to beat here. We've got everything lining up right there. To the downside, 332. This was a little bit messier, but it was a frequent stopping point for price here. We topped out there many times, closed around there and around there as well. And that was about where we hit the recent lows. It's also the site of our volume profile point of control. So around 332 is another critical downside point.
All right, so we've got a little bit of range that could potentially lend itself to some volatility in Domino's. Support kind of nearby, but yeah, there could be a pretty decent trade for 4 or 5% in either direction right now. It kind of seems like the stock is moving, so it's an interesting perspective. Thanks, Rick. Like it. And for the record, somebody puts Domino's in front of me, I'll eat it. So let's be clear. Thanks, Rick. Thanks, Jenny. When we come back, the promised earnings are living up to the expectations. Union Pacific up next. Despite a decline in revenue, shares are up.
I remember when I first started flying and we would experience turbulence, I would watch the flight attendants. If they're not nervous, then I'm not going to be nervous. Financially, I'm the flight attendant in that situation.
So you have 6 now. Six and a quarter. GME's down 2.5. Sob up here. The chart's ugly.
the earnings were actually due to help from a lower tax rate. So if you took that away, which of course you can't, but if you did, it'd be a slight miss versus the expectation that we have there on the screen. So that's notable. Operating ratio did deteriorate by 350 bips to 63.4. This is about 80 bips worse than the expectation was. So something to watch as well. And then going forward, it's going to be, you know, the cyclicality. Industrial production expected to be relatively flat. What does that do to impact, you know, things like carload growth for a company like Union Pacific?
Okay. So pretty good report considering that things did slow down. Some of the managerial decisions, and I guess the market's confidence in the CEO too, it sounds like.
No doubt, and I think you know, having someone who's been a long time member of the industry is of course going to bring confidence. This was kind of a well-telegraphed sort of transition, a few months into the job, and of course you can see that downwards tick since the last earnings. I think that also helps to kind of lower the bar a little bit. This is going to be another one of those key themes, I think, in this earnings season across the board, Oliver, is while margin compression is going to be a key you know, kind of talking point and focus, a lot of these names have sold off pretty substantially quarter over quarter. And what does that do to these reactions? Do you have a little bit of the selling of the rumor, selling of the concern, and then that relief buying when it's not as bad as feared?
True. All right. And it's definitely carved out a
to
chart
11.
very unique to itself. So to trade
40
on
minutes till
some
EU
of these very
close.
stock-specific items
Hour
as well
and
kind of
10
makes
to shape
sense.
how.
Even though we think about rails as
Buys down
macro-connected
0.2%.
and cyclical, the shares have been very unique
AMC up
in terms of
6.
their trajectory. So
GME's
one to
down
keep an eye
almost
on
3.
maybe here. Thanks, Alex. All right, that's a lot of earnings this
Friday's
morning.
up 55.
Let's bring in the team, and Scott Durfee
Netflix
kicks
is
it off
holding
for
on.
us. This morning
15%.
in our market meetup,
AT&T still
Senior Manager,
climbing
Trading
up
Education, Charles
7.5.
Schwab. Scott, pretty mixed picture for earnings. You know, you can find basically winners and losers in every category, and so I guess that's why the market here
Mullins
is kind
down
of stuck.
17.
We're off, but we're not too far
Flicker's
off.
down 10.5.
You know, earnings is a part of the picture. There's no doubt, right?
Oh,
But you
guts,
know,
I can't believe you
think,
made it out of this
Oliver,
stock.
enemy number one to the
Take
markets
me
right
with you.
now are these surging bond yields, right? I mean,
Absolutely.
we
Tesla's down
can't
8.8.
we absolutely can't
Tesla's
discount
still selling.
or
Wow.
just kind of overlook what's happening on the earnings front. But we do got to be cognizant also of what's happening with the bond yields. You know, there's nothing real magic about a round number like 5, but you know, there's a psychological effect that as we get there, that you know, potentially we're going to start seeing maybe, you know, some more problems, some more issues for at least the bulls in the market. You know, so again, you know, that 5% 10-year yield can actually serve as a psychological magnet for some investors. We'll see how that goes. You know, on the earnings front, though, you know, we're seeing,
Back
like you
into the
said,
channel
some mixed
here.
stuff. You know, Netflix comes in, they've got some new
Maybe.
approach, new news, some. You know, I think that part of the issue with Netflix in the past was when they kind of put a stop or hampered the password sharing. Well, I think customers in the beginning were like, well, okay, I'm bugged by that, and so I'm not going to get into stay with Netflix, and we may have seen some pull off, but I think we're over that now. I think people have been without Netflix long enough. They're diving back in, and you know, so on. So, you know, good news, bad news. I mean, it's a mixed bag of tricks today. We'll see what happens when Fed speak. Jerome Powell comes out, and we'll see what he has to say, and we'll see how the market has to react to that as well.
Yeah, coming out in about an hour, or a little bit more. We were just looking there on some of the earnings movers. A few of the names we talked about earlier, like AT&T, are up pretty big now.
Take puts
American
on this
Airlines
break.
firming up. Nick Theodorakis jumps into the
take it
convo,
easy this
financial risk
morning.
management
Take
director.
it easy.
So Tesla, being the biggest name, is clearly limiting our upside, Nick. But so far, these are not terrible earnings, especially after yesterday we heard from Lizanne that so far this quarter, companies that double beat were getting the smallest rewards, and companies that double missed were getting hit pretty hard. Oh, we might have lost Nick there. So Scott, I feel like it's a little bit of
I just
a
thought he
reprieve
was
here,
very
you know,
stoic.
that yes, Tesla down 9%
yeah, 9.
is going to prevent a lot of upside, but we're not getting much downside either. And that's kind of the story of the market here the last couple months, especially for the NASDAQ, which has held the summer lows and continues to do that here this morning.
Yeah, you're right, Oliver. And as we see these
I'll
kind of
take some
things,
profits at low
this
day.
almost appears like there's some things that are firming up, and as we start to see some of that action or some of that behavior from the market, especially when it comes to price action on some of these stocks that are reporting earnings, as we see some maybe signs of firming up, I mean, at some point this market's going to have to move one way or the other. And yeah, Tesla's got a big pull, obviously, because of their market cap, but we can't discount what's happening with the other companies as well. And so, again, there's a lot of stuff at play here. We had some good numbers today, really, actually kind of surprising numbers today on the jobless claims.
Yeah,
and
shocker.
all of this. Yeah, and I heard Kevin, Hink say it earlier. He's like, "Are you kidding me? What are we seeing here? This is just unreal that we can see these kinds of numbers." And I think these numbers, are important. I think what's happening here is really important. We'll see what happens, with again what Fed Jerome Powell has to talk about later. We'll see how all that goes, but. We're in a spot where, typically right now we would see we would begin to see the beginnings of a firming up market. That's just typically the way it goes this time of year. Well, we've got some pressures that are preventing that. So how it's all going to play out is one man's best guess, but let's sit back and watch and be prepared for whatever does happen.
Yeah, it's a good point. Seasonally, right? Things are supposed to improve here. But when you got rates ripping to 5%, Tesla down as big as it is, that might outweigh a little seasonal bounce and a good setup for us for Jerome Powell. Appreciate it, Scott Durfee, you the man. All right, that's it. Trading 360 with Nicole Petalidis is up next. I'll see you this afternoon at 2 p.m.
Gas City. Ramen's up 3 now. Still below that resistance. J Blue up 3.75. J Blue. By just retesting the break on that channel. Pretty choppy though. I wants J Powell. Yon down 5%. Run down 4.25. Lucid breaking down there. You're down 9.5. Waiting to pounce, huh? What are you gonna pounce on? Puts? Puts pouncing? You waiting for J-Pow? I mean, the premiums move with at the money, right? Are you just looking at a certain strike? Waiting for that to get cheap enough?
Market leader when it comes to chip manufacturing and hardware, especially when it comes to AI and generative AI. I think NVIDIA is a good pick.
Right, understood. And then you turn your attention away from AI over to industrial type names. We think about what's going on with infrastructure and spending. Caterpillar has been on your radar. What are you watching there?
So a lot of the reason why I'm following Caterpillar is actually due to the inflationary environment that we're in. While I still remain very positive about what the Fed is doing, I believe that when it comes to stocks that kind of wear over or are kind of very good in an inflationary environment, that's where I go into industrials. Caterpillar is one of the leading kind of producers of like machine hardware that goes into construction infrastructure. They've turned over, they have a 2% dividend yield and have a 12.9x earnings. So the company has been doing very strong. And when it comes to inflationary and highly inflationary environments such as this, you want companies that have good traction, good market leadership, and who are capable of wearing
Don't forget we have Powell at 12
storms when it comes to these environments.
And last but not least, Diamondback Energy. Most of the folks I speak to still think that energy's path of least resistance is to the upside, maybe to $100. What is your thought on Diamondback today?
So my thoughts overall on Diamondback are still remain very positive. Again, when we're talking about the energy sector in the United States, we continue to do a lot of investing into oil, gas, and even with the crisis that is happening right now in Gaza and in Ukraine, oil prices, while they are up, we continue, like oil manufacturing is still doing very good. It's a profitable business. We continue to need oil manufacturing, and Diamondback is one of the leaders in that regard. So I still remain very positive on that as well.
Good to chat with you. Victoria Bills, thank you so much at Banrian Capital Management. Thanks for being here with us today. Thank you. Up next, it's the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein will go through those technicals. Alan Nuckman, stand by. And he has trades for us. AMD, Smartsheet, Bank of America. You want to hear more right here on Trading 360.
Definitely building liquidity here. Got some up here. Be building up for an inverse head and shoulders. Or just another bear flag, but I think not Powell. A little tough. I think a breakdown here, though, we could see pretty big downside. 427.35. 426.28. 425. No, I wish I already got my February puts. Still have Santa Rally lurking in the back of my head. But maybe that doesn't come till mid-December. Sell off before then. Or if JH is still buying Mullen.
picks for us today are names you're watching closely. AMD is the first one up. What is it about AMD that jumps out at you today?
Well, I like how tech's been leading the way. We've had 3 consecutive positive weeks in tech.
This guy flexing on his beach house.
And it's holding this 15,000 level, which is pretty important here. And what we're seeing is it filled in that gap that we had in September 19th to 20th. There was a gap down. Now, the S&P hasn't filled that yet. We'll come back to that in a minute. But I'm encouraged by how tech has filled that gap on the upside and has been holding. Looking at AMD had a big run from 60 up to 130. 95 is the midpoint of that big rally run. And guess what? That's where it held on this little pullback here that we've seen. We've got a nice bullish flag pattern here forming, a breakout of that flag, targets a big move. So I'm looking at the fact that you're also seeing leveraged option buying. So that's a very positive bullish sign. And looking at an option, I'm looking at a January call, that 95 strike. It's trading for about 15 right now. It's deep in the money.
I broke that lower level.
Well, if we can just get back up to that 115,
we're into the channel,
level, which is kind of the mid of this pullback that we've seen in this larger overall very, very strong trend.
Yeah, understood. I mean, we were just talking about NVIDIA a moment ago. What do you think, Ben, when you take a look at the
choppy still 15 minutes to you close?
Well, I see a stock that's trending higher on the short term. Unfortunately, it looks like it's already started to roll over. And on a more longer term time frame, it's still in a trend environment to the downside. So this is exactly what the bears are looking for in many instances. Taking a look first and foremost at a look at the more granular time frame. We've got a 15-minute candle chart here, and I do just want to speak to some of the strength we've seen, because Alan was talking about a big run up here, and recently over the last few weeks, just going back to the lows we saw back around the end of September, down around 94, all the way up to 111. But as you take a look, more so as of recent, it appears as if we're starting to roll over a little bit and kind of losing some of that momentum to the upside. And that's why I start to look for some of these areas of consolidation that have formed, because they're going to help us determine if this trend that we're seeing to the upside still remains intact. And in this instance, you can see, unfortunately for the bulls, it doesn't. Why? Because, well, we were establishing these areas of consolidation to the upside, but look what's happened here. After forming one around 109, we started to break down. You can see not only taking out 106, but down to that key area 102. So losing momentum to the upside, and this happens to be in a trend environment to the downside as you look at a longer term time frame. And it just happens to coincide. That most recent failed attempt was right around this 112 level, big area right now. It's a retest of the highs from the end of August, beginning of September. Now, if we continue to show some weakness through 103, we're going to open up a door for a retest this lower extreme here down around 94. Let me take a step back. I want to show you where we are
on daily candle chart here, how we're kind of pinched in between the 50, the 200-day moving average. You can see not a lot of conviction as of recent, but again, also a series of lower highs. You can see how momentum RSI is starting to roll over a bit here as well. Take out the September lows, and you could see some energy to the downside here.
Okay. And, you know, what are you thinking when you hear that possibility of that energy to the downside? Alan?
Well, Ben and I are both chartists, but artists. You have to be able to see into those charts. And I see a bull flag after a big run up, so off that bottom. So, and I'm also seeing that leverage buying for me is a very, very strong indicator of smart money participating on the upside. Now, the 95 level is important to lean on because that's a 200-day moving average. It held a support. It held as a halfway support level midpoint. So that's what I'm leaning on. I'm looking at a 95 call, and again, January option has 3 months of time to see if this can bounce back. And I've got confidence in the tech sector, being that it filled in that gap and has been holding strong.
Okay, understood. It's at 103 today. Next up, you have Smartsheet.
AMC come down here.
This one too often. Tell us.
Back to BBBYQ maybe.
It's just a chart that popped up on my screen. It's got that bullish leverage buying, which is something that I follow.
GME, new lows.
It's been sideways.
Down
and
4%.
we'll both agree that the longer something trades sideways, the longer time, the greater the
breaking out of that channel, but
oftentimes. So we've been seeing it between 40 and 50 now for 2023.
Waiting.
Again, I'm looking at a January option, a January
Maybe
35
till
call, which
Powell.
is below that 40 level. The 35 calls trading for about 9. So, you know, there's some positives here. And it's just looking forward to break out and positioning with a limited risk in the money option to do so, counting on that leverage buying indicator that shows that money flow into that stock at this time.
Right, and that's the whole thing. When you watch that on your screen and you see what you think is bullish moves there, let's see if Ben agrees.
Yeah, I do. This one's been sideways for the most part. I agree with Alan. It's just a matter of time until it breaks out. Unfortunately, it just retested and attempted the breakout to the upside and stalled. Let's begin with the sideways consolidation because it's basically been 47 to 38. You can see not a lot of conviction on this chart here. A lot of rotational, kind of this wave type pattern that plays out. You don't have a really well-defined trend up or down. And as I take a step back,
One day closer to $10 for GME.
At this point that what we really have here is just a well-defined upper
some
and
support at
lower
12 and a
extreme.
half.
That's it. So not a lot of information here, but we do have 48 and we've got 38. So we know that the middle of that range is kind of the pivot area. We're hanging out there. Let's move away from the 30-minute candle chart here and into something that's going to provide us a little bit more information. We always say when in doubt, zoom out. Alan's talking about how we have been in this area of consolidation, and it's sort of that pop bottle mentality, right? Once you shake it up enough, eventually once it releases, there's going to be some energy associated with it, and this is shaken up in this range. That's for sure very random, limited in terms of real conviction relative to that longer-term trend
there it
we've
is,
seen
maybe.
to the downside. So high conviction to the downside on
Below
the
there on
30
SPY.
screen, and then mostly it's been
I'm still not liking the
sideways
price
since.
action
You can
today,
see how
though.
we've been bouncing around
And
38, so
J. Powell,
holding
Mark
above
kinda
that
waiting
right
on
now.
that.
But I
I'm
also
just-
mentioned again how we just recently kind of tested and attempted to get something going to the upside, potentially a bit of a head and shoulders pattern even forming.
yeah,
there.
you saw the channel
Wanna show you
break.
where we are on the 50, the 200-day moving
Happened
average
up here
is
too,
holding
just
above both. RSI though somewhat
a different
limited
way.
in terms of participation of the upside. So again, sideways to slightly lower
But the
is the
problem
read
is-
on this one for me.
It's very choppy
And
still.
so the
A lot of liquidity
RSI
being
doesn't
built everywhere.
Love your ideas at this moment, Alan.
Well, one of my triggers is also the 200-day, and we popped above that, so that's a positive. Now, like Ben said, we failed our first time, but this option has 3 months of time, and it's $8 in the money, trading for about 9 or so. So, you know, it's the way to play as much as the stock, but I'm looking for the stock to shake out here. I really like this bottom pattern, and we've seen this time and time and time again.
All right. And last but not least, we'll take a look at Bank of America after we've obviously in the thick of earnings season. We're getting quarterly reports from these banks. What say you about Bank of America?
Banks are banking it, okay? Now, in this example, I know Ben's going to say BAC should be BAD. It's a bad chart, I will tell you. But it does have my bullish divergence, meaning it made new lows, it tested the downside, and rejected the downside. Now, it dipped down. We had been trading here between 27 and 37 for a year. Now, just recently, we dipped down, made new relative lows, and couldn't get any strength, and now we're back inside that range again. That's very much a positive. The trend overall is down in this chart, but banks are making billions. If you combine, Citibank, Wells Fargo, JP Morgan, and Bank of America, these four banks, their last quarterly profits just listed last week, those four banks came up with a $30 billion quarterly profit. Banks are printing money. They pay their depositors less than they're getting in overnight repo rate, so it's just a free grift until depositors realize that they need to get that higher yield. And we'll see if they do. All right, the way to play here, an April option. April has 6 months of time. This stock is bad enough to buy. It also has that leverage buying money flowing in. So I'm looking at the 25 call. Again, 25 is a multi-year low. 25 call, and that's trading for about 4. It's obviously in the money, and it's got plenty of time for performance. And you know how this works. When the sentiment shifts, and that's what I look for, is that sentiment shift sign of that bullish divergence, meaning we made new lows, but not new highs in implied volatility. That's a sign that the short sellers are running out of strength. Go to it.
Okay.
Go on BAD, Ben. BAD.
BAD. I don't know. Let's see what Ben says.
Nicole, I'll give Alan the fact that we have seen a bit of a shift recently, but the longer-term trend remains the downside, and we just failed at a key level, much like AMD. We're going to start off with a more short-term time frame here and look at the recent trend because it has been to the upside. A couple weeks ago, we were trading down around 25. You can see some of the momentum higher recently, topping out around 28. The question is, again, with AMD, are we starting to roll over at this point, right? Let's take a look at a couple of the areas that my eye was drawn to in terms of consolidation, where values formed and where the market's kind of paused. Because in theory, the way I see it, as long as we hold above the 26 level, this one is still establishing value to the upside. So again, I will give Alan the fact that there is some momentum higher at this point, but I want to show you what I'm looking at, even more importantly, stepping back from that 30-minute candle chart where there's only a certain amount of information that you can gather. Taking a look here, this one really speaks to what Alan was talking about in terms of how this chart is really not what the bulls were looking for in terms of shares of BAC. They've been coming under pressure, to say the least, recently down to 25. That was a level he pointed out. You can see how we're off that level here right now, but let me show you what's going on as we kind of test and retop here right around this $28 level. Let me show you the areas of consolidation that form. Now, these are 4-hour candles that we're looking at here. So this chart's going all the way back to, we're talking end of July, 32.50, all the way down to this $25 level. And again, if we break down below 26.75, we open up a door for a retest of that lower level. I don't really see a rejection as of yet in this instance, still exhibiting some weakness, mainly leaning on this 28, this upper extreme here right now, and that failed, or that potential double top at that level. Let's take a look at where we are, much like we did with the other two names we looked at here today, Nicole, in terms of relative to the 50, the 200-day moving average is also where I'm kind of leaning on that bearish narrative here. Look where we are. We're holding below the 50, well below the 200. RSI is showing a little bit of enthusiasm to the upside, and again, I just think with this longer-term trend,
30 minutes to J Powell, 35.
Starting to roll over on the short term. This is again
if we
in
get
line with the pattern that's been playing out.
J Powell run up,
lower highs, and take out 25, and you open up the door for further weakness there as well.
All right, and Alan, look, not a
bounce
year
back up
200-day
into this
moving
channel.
average that you like to see.
Next, I'm looking to
Final
break
thought.
this high
again,
right here.
You have the right to be long from 25. It's like putting in a limit order to buy at the lows. You've got limited risk. It's in the money. And if you've participated in BAC when it looked bad in the past years, it's bounced back. So I'm just looking for a modest bounce back. That 32 level is a halfway point of that range that we were in. So if it just gets back to 32, this option doubles in value, and I've got 6 months for good things to happen. And like I said, banks are banking.
Banks are literally printing money.
Alan Nuckman, bullseyeoption.com. Ben Lichtenstein. Thank you both for the big three today. Great to see you both. Really appreciate it. All right, up next, we're going to spotlight a new direct listing on the NASDAQ. The CEO of Urgently joins us right here on the show. We'll explain all about that. And remember, be sure to tune in next week. We have special coverage from the Schwab.
Taking a little profit there. It is back up in this channel though, which is good. It's bullish. I want to see it break this resistance. Add some more. You close in 10 seconds.
We have 100 customers globally in 26 countries. In the US, we have full North American coverage, 24/7. We work with 12,000 small and medium-sized business operators that provide roadside assistance and about 60,000 or so drivers. I think I mentioned that, quality is important to us. We've done 4.5 million roadside assistance jobs since the inception of the company, with an average customer rating of 4.5
Oh, is this the EV
out of 5
charging?
stars. And again, I think it's really
like mobile charging?
our commitment to quality and really about our ability to take machine learning and push it in a direction that improves and constantly scores jobs and improves it for the customer outcome.
Just to give people the understanding, I mean, so vast, 4.5 million service requests. What are some of the most common? I know we have electrification going on here at home, but more so even abroad in certain countries. What are some of the most common requests that you have to deal with these roadside assistance services?
Probably things that you're familiar with. It's flat tires, it's jump starts. You'd be surprised on electric vehicles. There's a good number of flat tires, and of course battery recharges. And then, towing is a big component of it too. If you're in an accident or if your car breaks down and can't be driven, then of course we send the service vehicle out to service you. I think it's probably important for the folks to to understand that we actually don't operate our own vehicles
Yeah,
or
I'm
own
closing
trucks.
some
The
there.
company is very asset light. What we do is we provide the software platform that connects the digital assistance with the customer, and then with the OEM, and then with the service provider on the other end, everyone together in a kind of a seamless experience. And then once the experience is finished, the customer can rate it, and the service and the car is delivered to the dealer.
Yeah, and as technology improves, as AI improves, and
At
you're
least you should
this
see
go
VWAP
between
test.
someone in the car with a flat tire, trying to get them to connect to the type of truck that they would need
Maybe the
to
top of
come
this
and
channel.
help them.
Break
How
the
is
channel would be
technology helping
bullish
you
for
for
high
potential
day.
growth in roadside assistance services going forward?
It's been amazing. I think if you look at the company urgently as a standalone business, last year we did close to $200 million in revenue. And then if you look at the gross profit for the first half of the year versus the first half of last year, we're up almost 300%. So and it's really a testament to the machine learning and how we're actually dialing into the customer service and scoring every job. We spend a lot of time on technology, and we constantly run thousands and thousands and hundreds of thousands of different scenarios to figure out how we can improve something. And it's really about placing the job with the right asset at the right time. It's really it's an interesting kind of geospatial search problem that we've solved. And we're excited that we can kind of bring this to the market and start to expand into other adjacencies.
Right, understood. Tell me also, as you look at the big picture on here, you didn't do an IPO or a SPAC. You did this direct listing. How did that work for you? Did you feel it was successful and the right path?
Yeah, I think that we're on the right path. I think the company is poised to do extremely well. We have some exciting news that's coming down the pipeline. There is no right way to do this. We looked at a variety of different things. We looked at an IPO, we looked at the SPAC, and we looked at direct listing. We thought that where we were, and given the merger, this was absolutely
Wasn't
the best
another
thing
one
to do
there.
it. And again, I think if you take a step back for a second, really what we're building is an operating system that sits on top of this
Ooh,
business,
there you go.
much
We'll
like
break a VWAP.
human resource capital or CRM
All
or
you have to do is
supply
close,
chain. Like that's
close a
really what
couple,
we're trying to build
let
here.
it go.
And it's that software platform that will give us adjacencies to move into other, margin
Top of this
rich
channel, closing
categories.
another one.
Right, understood. This is exciting, and we wish you continued success. It's great to see you. Matt Booth, CEO of Urgently. Now you can check it out. ULY. Thank you. Coming up next, it's the Disruptors. George Stills is standing by. He has a name in the solar space he's going to tell us about. First Solar, an upgrade, coming up.
Okay, put a stop on those. On the rest. I've got some contracts for tomorrow and then some dailies. I have dailies on my 2 trading accounts. Uh-oh, guts. Doesn't sound good. You should have the opportunity with JPOW on in 22 minutes. I want to be forcing trades though to try and make up for the week. Let the trade come to you. Not there, just wait till next week. No making up. Just forward. Apply this to myself too, because yesterday was a pretty big red. Big red. And I'm as much as I'd like to make it all back today, not trying to. Still have a right inverse shoulder it could grab right here on this channel break. But it's just getting ready for JPOW at safety of VWAP. Probably close out of more before Powell. Levy wise. Got it queued up, we'll be listening to him.
On the Inflation Reduction Act, which was from last year, summer of last year. But at the same time, we've got fiscal year 24 budget resolution that's in place for 6 weeks until November 15th, and until then, we have some questions about whether the next year's budget will include additional tax subsidies and, of course, credits for solar companies. But for solar, I think is performing well relative to some of the respective peers because it's a company that's really focused more on the commercial and industrial side of the solar market versus the residential one. And I think if you look at the scalability that's involved in utilities, which are now deploying solar arrays for electric power production, but at the same time solar farms. So these are scalable operations which have benefited quite nicely because of government stimulus, but also, of course, based on the secular trends in the transition towards electric use in terms of solar energy use.
Not going to add here just because JPOW's coming on.
Overall, if you look at the divergence between some of the other solar names we've actually covered, like SunPower or even Sunrun, you can actually see First Solar has been performing quite well relative to those other ones because of the fact that it's more concentrated in the industrial and commercial space. And I think when you look at JP Morgan, they're looking for a company here that has some pretty good earnings growth relative to its forward multiple. The estimates for earnings are about 40% growth year over year going into 2024. The stock is only trading around 17 times forward earnings, so it's trading at a discount relative to its growth. But at the same time, I think there's some concerns about what's going on next year in terms of the budget, which again hasn't been clarified just yet. So I think this is one of the reasons why they increased their rating on the stock to outperform, but they adjusted their price target from 239 down to 220. So I think they're being a little bit more conservative here, contingent upon some of the elements behind the fiscal year 24 budget, which hasn't been resolved as of yet.
Yeah. So if it tilts to risk reward favorably at this point, and this is what the analyst is saying, I saw some concerns about the money that the company is spending or losing is a better way to say it. So there's back and forth when you read the analyst reports. Some seem to be more positive than others. First Solar today at 152 and change. Tell us about an example trade, George.
Yeah. So I think the stock is going to be kind of drifting, if you will, until there's some resolution, Nicole, or maybe into Q1 or Q2 of next year. So I'm not going to be aggressive here. Going to be a little more conservative. So what we can do is go out to November with about 30 days to expiration and sell cash secure put. So effectively, in the month of November, selling the 140 put, you could sell that for about $5 a share or $500 in credit. And so that strike price is, of course, below the current price by about $12 or so, but you have about $17 of flexibility down to the 135 before you hit break even, and that's about 11% give back relative to the current price before you're at risk of losses in this trade. But by placing this, you have to be willing and able to take on ownership if the stock does hit 140 or lower between now and expiration, because 140 is essentially the assignment price, but your purchase price net of the credit you receive is 135.
Yeah. All right. Thank you for all of that. A good look today at First Solar. 1 year up 25%, but as you noted, hitting that high in May of 232, and has been to the downside. So good trade for us, example trade there. George Sillis, we appreciate it. Thank you. Coming up, all things Tesla. The stock is down about 7-8% today. Our panel is ready.
Well, those calls might work out still, Guts. J Powell could pump the market 2%. He comes on in 15 minutes. We'll be listening to him. I've got it queued up. Right now, this is this Chamber of Commerce? What is this? What is this building? I don't know. Oh, we're ready. Market's getting ready. Let's see. We want J Powell. We want J Powell. We want J Powell.
Of Tesla, absolutely. I think they're going through a tough time right now with the Cybertruck ramp. But ultimately, what Tesla is trying to do is so revolutionary, it's so different from any other car company. And I think they will succeed. So you want to take opportunities like this when the stock is down and really, if you don't have a position, maybe take one.
Yeah. So what did you think about the report, Hatem? I mean, what jumped out at you? You said it's a tough time and it was somewhat baked in. Why?
Honestly, it was depressing. You know, I think Elon sounded tired. He sounded deflated. There's a lot going on with the Cybertruck ramp. It sounds like, you know, they're going through a tough time. I think he, you know, maybe distracted a little bit about what's going on Twitter. So, you know, and obviously geopolitically, there's a lot of things going on. So I think he's worried about interest rates and the economy slowing down. So all that came out in the conference call. Elon is someone who wears his heart on his sleeve. You know, he's not scripted. He goes in, you know, however he feels. You can hear it in the conference call, and that was yesterday.
Right. Okay. What did you think about this, Steve Wesley? First, tell me, do you think that Tesla's a buy at 220? And tell me what you thought about the report.
Look, long term, I think Tesla's absolutely a buy. No doubt they had a slow quarter in Q3, but people expected that. Tesla had been very forthcoming. They were going to slow down a lot of their facilities as they retooled to make them more efficient, and also to give the Tesla Model 3 a much needed facelift with the new Highland coming out. But at the end of the day, I think they're going to come roaring back in Q4. What people don't realize is Tesla's taken the cost down 25% this year. That brings the Model 3 down to about $30,000 after rebate, $32,000 from the Model Y. I think they're going to come roaring back in Q4 with awfully big numbers. But long term, the reality is Tesla owns 50% of the U.S. market. They're selling more EVs than everybody else combined, and they're clearly number one globally. Tesla Model Y, largest selling car in the world, electric or gas. So I think they're pretty well positioned. The big question is, can they stay ahead of BYD? There's a clear number two challenger, and I think BYD is going to give them a run for the money. But long term, the whole world's going electric, and Tesla's the king of the hill.
Yeah, and you know, there's an article here that even Tesla needs to tone down its EV ambitions. Elon Musk saying we need to make our products more affordable so people can buy them. Steve, is this a good thing here? Because you do expect record numbers for this company going forward in the fourth quarter, right?
Yeah, absolutely. Look, there's two things going on. Elon's absolutely right. He's playing the long game, and he's saying if we're going to be the dominant leader over time, and again, the Chinese are coming, lower cost models, he's got to keep an eye on cost, and I think they're doing a better job of that than anybody else.
Lots of put volume.
Again, no one
I'm not married to calls at all. I just saw the trade and took it. So flip into puts. No problem.
In terms of net profitability, they are number one in the world right after Porsche. So if they can keep that up, they're going to be in awfully good shape. Plus, they also have the Tesla Energy division, which is growing like crazy. That may turn out to be their secret weapon.
Yeah, and we want to talk about that, but we're seeing all the EV makers down today. In fact, with the revenue growth, it rose
a little more profit on these here.
That was the slowest growth that we've seen for this company in more than 3 years, Hatem. And we know that
I might just keep my dailies for some lottos.
BYD has been a big competitor, and many, many, many more. What are the
like
expectations
stop loss
of Tesla too high now as the rest of the industry is playing some catch up?
I don't think so. I think the macro environment is really something that every car company and EV company has to look at right now. With rates being this high, and Elon talked about this a lot, you know, the affordability is a problem for any really car buyer, right? So slowing down there is going to be problematic for anyone who's trying to sell EVs. But what Steve said is absolutely right. Like, the adoption is going to continue to grow. And Tesla is a company that can actually control its margins. They actually, the more cars they make, the lower the cost of those cars become. And as a result, you know, they're playing this game about reducing prices to find really the right pricing metric. And maybe that hurts the margins short term, but long term, they're just going to have more market share.
Yeah. What did you want to tell us about this Cybertruck? What did you think there, Hatem?
I think everyone was super excited about some new information about the Cybertruck, but that information wasn't good. You know, they are having problems ramping up. Reminds me of 2015, 2016, where Elon had to sleep in the factory to make the Model 3. So I think that's where we are with the Cybertruck, unfortunately. But, you know, you don't bet against Tesla. They're going to figure it out.
Right, and the delivery is scheduled for November 30th. That's not too far out. Tell us a little bit about the energy business. That delivered some good news, Steve.
Yeah, and here's the fascinating thing, because most people think, you know, car company, energy company, how can this all be the same? Here are the facts. What they're selling here are power walls for people's homes, and then gigapacks for utilities. what a lot of people just don't think about, especially the auto analysts, is virtually every utility in the world is putting as much solar and wind up as possible. They need to store that energy when the sun's not shining and the wind's not blowing, and they're doing it increasingly through Tesla's gigapacks. So Tesla's energy division has grown from 3.6 billion last year to what appears to be something closer to 6.3 billion this year. They can continue that sort of growth. That really gives the company's numbers a boost, and they're getting high gross margins there. But ultimately, the big question here is, can Tesla continue to be a low-cost leader? And I think they're already making plans for the Tesla Model 2. I expect them to see a new model in the roughly $25,000 range come out within the next 2.5, 3 years. And that's something that they can sell globally. If Elon can execute on that vision, I don't think anybody's stopping him. Will there be bumps along the way, delays with the Cybertruck? Without a doubt. But if he executes like he is now, #1 in the world, every auto company going electric, they're in a pretty good place at this moment. And by the way, having $26 billion in the bank for growth doesn't hurt.
Yeah, understood. I think a lot of people agree. Tim, you were talking about Elon Musk sounding, he's just a little down, or however you want to describe it. I mean, I'm reading about that throughout this morning. People are saying much of the same. But when you look at the things that are going well here, the power walls for the home, the giga packs for utilities, the superchargers, we've spoken about this recently at MDM, but the naysayers will say those superchargers are nothing. They're 1% or some sort of, I don't have the exact numbers, but stop talking about them almost.
Oh, that is just not true. I think if you've seen how many car companies are adopting the Tesla supercharger network, or at least trying to get into the supercharger network, simply because it's such a huge advantage for anybody who drives an EV. I've been driving a Tesla for 5 years, and having the ability to charge anywhere I go without even thinking about it is just amazing. So the competitive advantage of that supercharger network is huge. And I think once they open this network to other manufacturers, they can regenerate between $2 and $2.5 billion in additional revenue just from energy there. And most of which, by the way, is generated through solar. So I think the supercharger network is just simply underappreciated.
And look, I mean, everybody still says that Tesla could very well be a beneficiary of the strike that's going on with the UAW. In the meantime, we've seen a sell-off, 2-day sell-off, a week sell-off here. It's down 12% this week. Obviously, the worst couple of days here of the year for Tesla. But as you both noted, for the long term, you're both saying buy. So it gives you some opportunities to step in on a name like this if you want it for the long term. Great conversation. Thank you both. Atem Diab, Gerber Kawasaki, Steve Wesley, the Wesley Group. Thank you both. And thanks for being with me, friends. I'm Nicole Petalides, live here at 11 for Trading 360, but I'll see you at 2 p.m. for the watch list. Join me then. Fast Market is next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction.
Buy back to its happy place at BWAP. Minutes. Got it queued up here on Fed Reserve site as well as YouTube. See which one's better. We get some big moves today from Powell. Very, very well. Could have taken a little more profit. Well. Oh shoot, he's late. Holy red candle. That's definitely skipping over my stops. Dude, dang it. Oh, maybe that's good actually. Maybe it skipped over him. No, it filled it. Got a stupid fill too. That is so jacked. Hasn't even come on yet. That is so jacked. Stupid. I was actually going to take some profits on it too, like thinking it might gap over it. And I was going to cancel when I saw a huge red candle, but I was too late. That's set for 260. It filled it at 246. The other one says pending. I bet it filled that one too. Talking anywhere? No, he's not even talking yet. Something happened though. He's super bullish, he's not even talking. Yeah, I filled the other one too. Dang. I wasn't expecting quite like this, especially without him talking. Maybe he is talking, just the live feed is. There we go. Oh wow.
Yes.
Left with one contract.
Good afternoon.
So this one's way ahead, but
Good afternoon, everyone.
this one has a lot better picture or audio.
Thank you very much for your attention. My name is Bob Steele, and it's my pleasure to welcome you to the 730th
It's way behind.
meeting of the Economic Club of New York. The Economic Club of New York is the nation's leading nonpartisan forum for discussions on economic, social, and political issues. Over the last 100 years, over 1,000 prominent guest speakers have appeared before the club. Today, in addition to those in the room, it's really a privilege to welcome students from NYU's Stern School of Business, Columbia Business School, Rutgers University, and Mercer University, all of whom are joining us virtually, and we also have the members of our largest class of 2023 fellows. They're a select group of diverse, rising, next-generation business thought leaders. Let's give a welcome to all of them who are joining us.
This is the only feed I can find that's
now to the order
clean,
of the
and it's
day.
like
Let me
30
welcome
seconds
back
behind.
to our club the chairman of the Federal Reserve
The parents
System,
and Charlie Brown.
Jay Powell.
Who's Jay Powell?
First took office as chair of the Board of Governors of the Federal Reserve System in 2018 for a 4-year term.
That was just a stop
He was
hunt.
reappointed to that office and sworn in for a second 4-year term in May of 2022. Jay additionally serves as chair of the Federal Open Market Committee, the system's principal monetary policy-making body.
Let's see if I can.
Issues. In New York City. And to a seamless on the board.
Can't even understand that.
Period of service at the Fed.
Guess which stream that is? That's the Federal Reserve stream. That sounds like crap.
Bipartisan Policy Center in Washington, D.C.
I guess the Fed isn't really the Fed anyways. It's not our government.
Fiscal issues.
It's not an actual reserve.
From 1997 to 2005,
I'll leave it
he was
there.
a partner at the Carlyle Group. Previously, he served as Assistant Secretary and as Undersecretary in the U.S. Department of the Treasury under President George H.W. Bush, with responsibility for policy on financial institutions, the Treasury debt market, and other related policy issues. Prior to joining the Bush administration, Jay worked as an attorney and investment banker.
Got you take any profits there?
In addition to his service on corporate boards, he's made a great contribution serving on the boards of charitable and educational institutions, including the Bendheim Center for Finance at Princeton, and also at the Nature Conservancy of Washington, D.C. and Maryland. Our format today is that Jay is going to begin with some opening remarks, and after he's concluded those remarks, he'll be joined in chairs with David Weston of Bloomberg. David is the anchor for Bloomberg Wall Street Week.
Dude, freaking protesters? Are you kidding me? They're gonna kick them off?
Thank you very much. Thank you.
Where's security?
Thank you.
What were they saying? Oh my gosh. They want their free money. Print more money. We're spoiled rotten. I don't know what they're chanting. I'm just assuming. They should have anticipated this coming. They could have seen those people in the crowd. Holy crap, they're like fighting them. Was there no security there? Is that the speaker fighting them? Dude, kick him out. Get him out of the building. How embarrassing. Oh my gosh. Oh my gosh. That all ends. You might get more of a move with Powell. I mean, if Powell's bullish, like I said, SPY could go 2% today. If you go even more. I don't know if he's gonna be that bullish though. Holy crap. Yes, you can clap now that they're gone. And then you can boo for how long it took. What's Jenna have to say about this? Can I? They're not saying anything. They're not watching it. Oh, dude, the Fed one actually turned off. Look at that. Little suppression of reality there. They actually just cut the feed on the Federal Reserve YouTube. Nothing to see here. Oh my goodness. Oh, I'm glad we're on this feed then. Wow. You can still hear them. What's going on? The market's like, hurry up and get him off the stage. We want to move. We want J-Pal. We don't have time for this. contracts are burning theta. Wow, that was not what I was expecting. That was exciting. Dude, was it the speaker wrestling them down? I think security did end up coming, but it looked like the speaker was trying to move them. Oh my goodness, terrific. If you haven't thumbs up the stream after that, that's probably the peak. So sorry, there's nothing else that's gonna outdo that today. Thanks to the 14 of you. That's crazy, man. J-Pow's gotta be careful. We don't usually see that side of it, but I'm sure he does have to be careful. Some kind of security detail at times, I'd imagine.
Pardon me? They stopped the feed, and so now, it's like so anyway.
They stopped the feed, yeah. The Federal Reserve stream has ended.
Thank you, everyone. The good news is I'm not going to repeat the introduction, and we'll start off where I was. Jay is going to speak for a few minutes and provide opening remarks, and then he's going to be followed by a conversation with Bloomberg's David Weston. David is the esteemed anchor of Bloomberg Wall Street Week. This conversation is on the record, and we do have media on the line and in the room. Let's welcome Jay to the stage. Jay?
All right, I'll shut up.
Thank you, Bob.
Thank you, Bob, and thank you to everyone for being here today. It's great to be back at the Economic Club of New York, where I last visited before COVID. So before our discussion, I'll take a few minutes to discuss recent economic data and the outlook for monetary policy. Incoming data over recent months show ongoing progress toward both of our dual mandate goals, maximum employment and stable prices. And I'll start with inflation. By the time we raised rates in March of 2022, it was clear that restoring price stability would require both the unwinding of pandemic-related distortions to supply and demand, and also restrictive monetary policy to cool strong demand and give supply time to catch up. These forces are now working together to bring inflation down. After peaking at 7.1% in June 2022, 12-month headline PCE inflation is estimated at 3.5% through September. Core PCE inflation, which omits the volatile food and energy components, provides a better indicator of where inflation is heading. And 12 month core PCE inflation peaked at 5.6% in February 2022 and is estimated at 3.7% through September. So clear progress there. Inflation readings turned lower over the summer, a very favorable development. The September inflation data continued that downward trend, but were somewhat less encouraging. And shorter-term measures of core inflation over the most recent 3 and 6 months are now running below 3%. But these shorter-term measures are often volatile, and in any case, inflation is still too high, and a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. We cannot yet know how long these lower readings will persist or where inflation will settle over coming quarters. While the path is likely to be bumpy and to take some time, my colleagues and I are united in our commitment to bring down inflation sustainably to 2%. In the labor market, strong job creation has met a welcome increase in the supply of workers, due both to higher participation and to a rebound of immigration to pre-pandemic levels. Many indicators suggest that while conditions remain tight, the labor market is gradually cooling. Job openings have moved down well below their highs and are now only modestly above pre-pandemic levels. Quits are back to pre-pandemic levels as well, and the same is true of the wage premium earned by those who change jobs. Surveys of workers and employers show a return to pre-pandemic levels of tightness, and indicators of wage growth show a gradual decline toward levels that would be consistent with 2% inflation over time. To date, declining inflation has not come at the cost of meaningfully higher unemployment, a highly welcome development, but also a historically unusual one. Healing of supply chains, in conjunction with the rebalancing of demand and supply in the labor market, has allowed disinflation without substantially weaker economic activity. Indeed, economic growth has consistently surprised to the upside this year, as most recently seen in the strong retail sales data released earlier this week. Forecasters generally expect GDP to come in very strong for the third quarter before cooling off in the fourth quarter and next year. Still, the record suggests that a sustainable return to our 2% inflation goal is likely to require a period of below-trend growth and some further softening in labor market conditions. Geopolitical tensions are highly elevated and pose important risks to global economic activity. Of course, our institutional role at the Fed is to monitor these developments for their economic implications, which remain highly uncertain. But I will also say, speaking for myself personally, I found the attack on Israel horrifying, as is the prospect for more loss of innocent lives. Turning to monetary policy, the FOMC has tightened policy substantially over the past 18 months, increasing the federal funds rate by 525 basis points at a historically fast pace and decreasing our securities holdings by roughly $1 trillion. The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation. Given the fast pace of the tightening, there may still be meaningful tightening in the pipeline. My colleagues and I are committed to achieving a stance of policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. We are attentive to recent data showing the resilience of economic growth and demand for labor. Additional evidence of persistently above trend growth, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of policy. Along with many other factors, actual and expected changes in the stance of monetary policy affect broader financial conditions,
wish I had those calls still,
which in turn affect economic activity,
Sorry, I'll shut up.
employment, and inflation.
250% though.
Financial conditions have tightened
70.
significantly in recent months, and longer-term bond yields have been an important driving factor in this tightening. We remain attentive to these developments because persistent changes in financial conditions can have implications for the path of monetary policy. My colleagues and I remain resolute in our commitment to returning inflation to 2% over time. A range of uncertainties, both old ones and new ones, complicate our task of balancing the risk of tightening monetary policy too much against the risk of tightening too little.
I'm closing this call on the trading
Doing
account.
too little
Last
could
one.
allow above-target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. Given the uncertainties and risks, and given how far we've come, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. Thank you. I look forward to our conversation, David.
Thank you very much, Chair Powell, for being with us today, for the remarks, and for having a bit of a conversation here. We really appreciate it. It strikes me it's a particularly propitious time, given everything that's going on in the world and in the economy. There's a lot to talk about, a lot to discuss. Let me start with something you just referred to, which is the surprise to the upside in the economic data, despite, as you termed it, I think, historically fast pace of growth. Are you surprised at how resilient the United States economy is? Just today we got jobless claims numbers, surprised because they were low. We got the retail sales numbers you mentioned. We got industrial production. Across the board, it seems like a very strong economy, despite all you've done to try to slow it down.
Yes, so we certainly have a very resilient economy on our hands. We've got the economy growing strongly. If you think back a year, many forecasts called for the U.S. economy to be in recession this year. Not only has that not happened, growth is now running for this year above its longer run trend. So that's been a surprise, driven largely by consumer spending, driven by a very strong job market with people getting jobs with first high nominal wages, and then as inflation has come down, real wages, which is spurring spending. And we've also had inflation coming down. So, it really is a story of much stronger demand. There may be some ways in which the economy is less affected by interest rates. It's hard to know precisely, but for example, many companies, any company with bond market access will have termed out its debt, right? And therefore may not be feeling the effects of higher rates. The same may be true of homeowners who have a long-term fixed rate, low rate mortgage, who then are therefore not, because it's not an adjustable rate or a higher rate, they're not feeling that increase in rates. So the economy may be somewhat less susceptible to the effects of rate increases. On the other hand, if you look at interest-sensitive spending, these are very much the places where we expect to see and do see effects. So, for example, in housing or the housing sector has been very affected by higher rates, as purchases of durable goods. If you look at surveys, people will not say that it's a good time to buy a car or a house, quite the contrary. So we see policy working through its usual channels. It may just be that rates haven't been high enough for long enough, and again, it's all happening in a context of very strong demand.
We've heard other people speculate that maybe the terming out of debt, as you say, both corporate debt and household debt, may diminish the effectiveness of rate hikes. Do you have a view on whether that's true? And if it is true, what does it say about monetary policy? Does it mean you have to go farther in the rate hikes, or do you just not have the power to affect it?
So no, I don't think that there's a fundamental shift in the way that interest rates affect the economy. There may be some differences in this cycle because of what I mentioned. As I mentioned, we are seeing the effects where we expect to see them, which is interest-sensitive spending and also asset prices to some extent, and the exchange rate, which you're also seeing a strong exchange rate, which is disinflationary. So I don't think there's a fundamental change in the way monetary policy affects the economy. And again, it goes back to just very strong demand. We take the economy as it is. We take fiscal policy and the economy and all the things we don't control. They come to us, and we conduct policy always to achieve maximum employment and stable prices. So we just take what comes. The fact that we have a strong growing economy, a strong growing labor market, and inflation coming down, these are the elements that we want to see to achieve the outcome we want. It may take more time, but ultimately, this is the kind of thing you would want to see along the path to getting through this without a big increase in unemployment.
Spy back to VWAP.
Thus far has the Fed had? We all have memorized now long and variable lags. How long and how variable, and where are you in that process? Are you at the 25% point, the 50% in terms of seeing it in the effect in the real economy?
So there's no.
I don't know. They probably want more free money.
Of how long lags are.
And
one thing
they're
that
getting
has changed
taken
in the modern era is that markets
off of
over the course of
the
the
sissy
last 30
baby
years,
fund
central
and
banks have decided
having to
instead
pay their
of being
student loan
secretive, to
debt.
be very transparent.
I
And
don't
what
know.
that has
I'm just
meant is
kind of
that
kidding.
markets
I couldn't
move
hear him.
actually
That's just what I'm
well in
assuming.
anticipation,
Protesters like
well
that, this
before
kind of thing would be.
our policy moves. So the transmission from policy moves to financial conditions actually happens before the moves now, whereas that was not the case 50 years ago when Milton Friedman, coined the phrase long and variable lags. So, but now you have financial conditions changing, and the question is, how does it affect the economy? The standard channels are asset prices, interest-sensitive spending, and the exchange rate, for example. And we do see that happening, just not as fast as we would like. And I would attribute some of that to just stronger demand. Household savings were turned out to be higher. Household spending has been stronger, and that's by far the largest part of the economy.
In order to conduct monetary policy effectively, do you need at least a hypothesis about how much has already hit the economy? Because it's hard to know how much more you need to do if you don't know how far you've come.
So on lags, I think if you think back, it's been a year since the last 75 basis point hike we did. It was at the November meeting in 2022. The first one was in June, so it's more than a year. So we should be seeing the effects. By the way, they don't all just arrive on one day. They arrive and then they're thought to peak and then to diminish. So there's a lot of uncertainty around lags. And one of the reasons why we have slowed down significantly this year is to give monetary policy time to work. The truth is, though, you can find academic support for different speeds and duration of lag. So we have to use our eyes and a little bit of risk management and patience in slowing down the pace to make sure that we are seeing the full effects. And I think, again,
I was just testing fidelity actually with the limit. I got one call.
We went
I'll
very
get somewhere though.
quickly in 2022 to catch up to where we needed to be, and now we're moving carefully with these decisions.
So when you spoke back in August of 2020 and sort of laid out the revisions to the framework, as it were, you said that in terms of anticipated growth, the sort of consensus had gone from something like 2.5 to 1.8%, I think were the numbers you laid out in that. Where are you now? Where's the Fed? Where are you? And what you think basically the long-run growth is?
Long-run potential growth is not something that moves around a lot over time, but my own guess is it's around 2%. I think that the standard mainstream view would be a little bit below 2%, but I would just say 2% real growth over time. And what causes growth is growth in hours worked plus growth in productivity. Growth in hours worked is a function of population growth in the long run, and also labor force participation. Many things affect productivity, but if you drop in reasonable, standard, longer-term estimates of hours worked growth and productivity, which is just output per hour, productivity growth, you get something around 2%, and that's higher than most other advanced economies.
As you look at it, do you see historical precedents for having a growing economy with high rates over a long period of time? I mean, as you look back, is it like the late 90s, for example?
Palestinians. I don't know, actually. Yeah, maybe they were protesting something with the war. I really don't know.
So that's really a question.
I didn't hear them
about
protesting yesterday.
What the level of rates will be going
They were at
what
another
the neutral level will be, and I think it's
event like this
very
protesting.
hard to know confidently what the answer to that will be in 5 years. Some of the reasons why rates were low for the last 25 years were just the aging of the global population and globalization, and so lots of savings and relatively with an aging population, savings greater than investment, so rates are lower, and productivity was low. So all of those led to low interest rates. So what has changed with the pandemic? You might see less effects from globalization. Certainly demographics, the aging of the global population has not changed. This is a discussion we're having on an ongoing basis. It doesn't really affect current policy, but where will rates settle out? What will be a normal rate? So if a typical Fed tightening cycle would leave you at 5 or 6%, and this is in the before the pandemic and before the low inflation period, you would have had Fed rates in 4 or 5% or even higher frequently. Are we going back to that? I really don't know. I wouldn't want to speculate. I mean, my guess is it'll be somewhere in the middle, but I don't know. I mean, I think we can say this now. The effective lower bound is not an issue. You know, we were very concerned about that. Right now, we're very far from the effective lower bound, and the economy.
Storming of Congress. Oh yeah, maybe it was.
But that's because we're at a time of really elevated demand, coming out of the pandemic as we reopened with fiscal stimulus and monetary stimulus. We have very strong demand in the United States. Hard to know what the economy will want in the way of interest rates when 5 years from now, when all of the effects of the pandemic are behind us.
You mentioned the long-term equilibrium rate, which you talked about again back in Jackson Hole in August of 2020. Back then you said you thought the sort of consensus had come down. I think it was from like 4.25% to 2.5%. Where is it today?
So I think by any reckoning, long-term interest rates and the neutral interest rate came down steadily over the course of several decades. So where is it today? I don't know. We're finding it basically. The idea was, I think the median indication of what the real neutral rate was around 50 basis points before the pandemic. It may have risen in the near term. The real question that matters, though, is will it rise in the long term? And that we don't know.
But do you need to know it in order to conduct monetary policy? I mean, you must have to have at least a theory. I mean, I'm not saying you have to be right about it, but you have to have a hypothesis, don't you? As you look at the data, you have to put the data through some sort of theory.
So we all write down our estimates of the longer run neutral rate every quarter in the summary of economic projections. And that's based on models. It's based on also looking out the window and including lags, thinking how are our current rates affecting the economy. So the evidence of your eyes is that the economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough. You're right, though, but we have models for everything. We have formulas for everything. Ultimately, as a practitioner, we have to be focused on what the economy is telling us, even taking lags into account. What's it telling us? Does it feel like policy is too tight right now? I would have to say no. I think the evidence is not that policy is too tight right now. And we're at 5.25 to 5.5%.
That's pretty hawkish.
A new phase in monetary policy. We had the Volcker disinflation, I think you referred to it as, and then we had sort of inflation targeting for a time. There was concern about secular stagnation. We were pushing the zero bound, as you said. We were concerned about that. And then we had the pandemic, and we had the real problem with inflation. What's the next phase look like? How would you describe it?
What we've been through is, in all of the advanced economies around the world, was a period where the effective lower bound, the proximity of interest rates, risk-free interest rates to the effective lower bound, which is zero or a little bit less, was a big problem for monetary policy. And just rates came down and down and down. And the problem is, if rates are going to be close to zero in good times, then how do you cut? And so have central banks lost the power of their most important tool, which is interest rates? This was a subject of a vast literature in monetary policy research for 20 years. And the most common answer was some kind of a makeup strategy. So you would credibly promise to run inflation a little bit hot and above 2%, and that would anchor inflation at 2% to counter the times when it was below. So that was a very serious problem, which filled books worth of research. Then comes the pandemic, then comes the response to the pandemic, and then comes the pandemic inflation, not just in the United States, but everywhere. The question is that a secular change, or are these factors that brought us to that place, are they still out there waiting to come back? And, books are written on this subject now. You can argue that, and some have argued that effectively the last 20 years before the pandemic were kind of a perfect storm of disinflation. And now that's all gone, and we're going into a more inflationary period that will be characterized by more supply shocks and things like that, and therefore more inflationary pressure. So are we going into such a... I don't know. I mean, all I can tell you, I think it's unknowable, and, great theorists and researchers have different views on this. It's not something you can settle in advance. We'll have to see. I think our issue is right now trying to achieve a sufficiently restrictive stance of policy to bring inflation down to 2% over time. That's what we're really focused on.
Whenever any of us go, particularly institutions, go through tumultuous times, and goodness knows you've been through a tumultuous time, we look back and think, okay, what do we learn? Sort of an after-action report. Look at the pandemic and then pandemic inflation. What would you say you learned in terms of macroeconomics, in terms of the economy, from that experience?
So hindsight is always a wonderful thing, right? I think the fair way to judge the actions that were taken is...
Could have taken a put on the break of this
yourself
channel, but I didn't.
The place of
actually grab my calls there.
And
my call.
Other, and central bankers around the world. And there was no playbook. We hadn't seen a global economic shutdown. People were thinking that
basically just gambling, trading during
kill
Powell.
A whole lot of people, and that we wouldn't have a vaccine for 5 years. We might not have an economy for 5 years. So these things were all very possible in March of 2020. And so we pulled out all the stops, and Congress pulled out all the stops. With the benefit of hindsight, could we have done a little bit less and had a little bit of inflation? I guess we could. But I think if you look overall at the performance of the U.S. economy, our economy is the strongest. We're actually also making the most progress on inflation, but we certainly have the strongest growth. We're back to prior growth trend, not just level of where we were. We're actually back to the prior trend. The labor market, the last time we had this many consecutive months of unemployment below 4% was in the late 1960s. So it's more than 50 years ago. So our economy is doing very well from all of that. But if
you can leg into it, Hugh.
You might not have had as much inflation.
Sell the next contract.
Although other countries
make it a
didn't
spread.
do as much as we did also had substantial inflation problems.
I think my question was just a little bit different. It's not so much of assigning blame or saying, did somebody make a mistake, as are there things that going forward would change the way you conduct monetary policy that you learned from that maybe nobody had reason to know at the time, but it was an experience you went through?
Well, we were in a time of a very long time, a reasonably long time, of disinflationary forces. And I think everybody's instinct had been attuned to risks coming from this direction, which is too low inflation. And so what this has taught us is that now that period is over, and we now have probably going forward a more balanced set of risks where high inflation and low inflation are both risks. In fact, right now the risk is still high inflation, but I'm assuming once we get back to 2%, we won't have that. But we've certainly learned that, and events are. The possible range of events is so much wider than what we think it is on any given day, right? The tails are so wide, and it's just not human nature to constantly be thinking about things that are way out in the tail, but they happen in financial markets and in economies. They happen far more regularly than they should.
I suspect every person in this room is well aware of what's going on with yields with bonds. It's been a big story, particularly in the longer end of the curve. What is your understanding of what is going on in the bond market and why those yields are going up, particularly, again, at the longer end of the curve?
So it's really two questions. One is why is it happening, and the other is why does it matter for policy? And so I would say on the why is it happening question, I think it's appropriate to have a little bit of humility. It's always hard to say exactly what's going on with longer-term yields, but this is what I think we can say. First, what it's not. It's not apparently about expectations of higher inflation. And it's also not mainly about shorter-term policy moves, so Fed funds moves over the next year or two. Really, if you can look at the 2-year, for example, and 2 years moved up a little bit since September, but really the move is in longer-run bonds. So it's really happening in term premiums, which is the compensation for holding longer-run securities, and not principally a function of the market looking at near-term fund rate. I think a few other ideas about. There are many candidate ideas, and many people feeling their priors have been confirmed by this event, I'll say, as well. But so one would be just that markets and analysts are seeing the resilience of the economy to high interest rates, and they're revising their view about the overall strength of the economy and thinking even longer term this may require higher rates. That could be part of it. There may be a heightened focus on fiscal deficits. That could be part of it. QT could be part of it. Another one you hear very often is the changing correlation between bonds and equities. If we are going forward into a world of more supply shocks rather than demand shocks, that could make bonds a less attractive hedge to equities, and therefore you need to be paid more to own bonds, and therefore the term premium goes up. So all of those are possible ideas. Then the question is, does it matter for us as long as I'm talking about this? So the way I think about it is, we change our policy. Actual and expected changes in our policy affect financial conditions, and persistent changes in financial conditions affect economic activity, hiring, and inflation. So one question is, are we seeing the longer run bonds, the increases in rates, are we seeing those come through in financial conditions in a persistent way? And I think if you look at financial conditions indexes, the answer so far would be yes, you are. Persistence, it will be a matter of just seeing with our own eyes, but certainly they're coming. If you look at financial conditions indexes, they're showing tightening, and it's a lot because of longer rates. Then the question is it endogenous? And is it just because the market expects us to take things, to take further actions to tighten monetary policy, in which case if you have to follow through. But that doesn't seem to be the case. It doesn't seem to be principally about expectations of us doing more. It seems that the other factors are the more prominent ones.
Another question is,
bottom line though, that means it probably does over time. It makes sense. It's something that we'll be looking at.
Well, that's the question I was asking, is over time. From what you understand right now, do you think this is a temporary phenomenon, or do you think there are structural factors, whatever they are, and we can talk about what they might be, that would really, this is the future that we're looking at now?
Well, so of the factors I just listed, some of them are shorter term, some of them are longer term, and some of them could be either. So, for example, concerns over fiscal deficits, that could be a longer term factor. The change in correlations between stocks and bonds could be a long term. I don't think we know. I think, basically bond prices are set by supply and demand. The supply of treasuries is a known thing, but demand can be affected by any and all of these theories, and also just by sentiment too, which is hard to characterize. So, markets have been volatile. They've been longer. You've seen the rates moving up and down a lot. I think we have to let this play out and watch it. But for now, it looks it's clearly a tightening in financial conditions, and so we'll be watching it carefully.
Talking about the fiscal side, and you've been very careful repeatedly to say you want to stay in your lane. You're not responsible for fiscal issues. At the same time, you have to take into account. And it looks like the United States is going to have to borrow a fair amount of money. By the way, other countries are as well around the world. We have a big supply of treasuries coming on board. To what extent do you think that is a longer-term issue? And let me tie it back to something you referred to in your remarks, actually. When we see geopolitical conflict around the world, like in Israel, like in Ukraine, some of the buildup with respect to China, the defense spending is going to be elevated for the United States and for other countries. Do you take that into account in figuring monetary policy? Because it may well mean that we're borrowing a lot more money than we have in the past.
So we, of course, see the same things that everyone else. I just came back from IMF meetings this weekend, and there's a lot of talk of the very large resource demands that organizations like the IMF and of course countries are facing, and the need for substantial amounts of revenue. You mentioned military. There's also dealing with climate change and things like that. So there's a lot of that. We don't, as you mentioned, we don't comment on fiscal policy. Actually, the fiscal authorities have oversight over us, and not the other way around. So we stay away from that. So I would just say everyone knows that it's not a secret, and about all I can say is we know that we're on an unsustainable path fiscally. It's not that the level of the debt is unsustainable. It's not. It's that the path we're on is unsustainable, and we'll have to get off that path sooner rather than later. It's not really something, though, that affects a monetary policy decision about how much we raise rates in the next 6 months. It's not going to be driven by. If there were some vast new fiscal policy that were about to be enacted, then that would have an effect on the models and would have an effect on projections, and indirectly that would affect us. But we would not be in a position of responding directly to fiscal policy.
When we talk about the treasury market, obviously there's buying and selling, and the United States government is issuing a lot of treasuries. There's also a question of who's buying, and we now have one buyer who stepped out of the marketplace, namely the Fed, which is a big buyer. At the same time, we're getting reports that maybe some of the overseas buyers may be pulling back as well. How do you take that into account in assessing where we're going with long-term bond yields?
So actually, I think buying by overseas entities has actually been pretty robust this year. So there have been some small changes, but I think by and large they've been buying robustly. Again, we look at the broad financial conditions. We look at interest rates, other asset prices. That's what we look at. We don't focus on fiscal policy. We wouldn't change monetary policy because of, for example, because we think that the U.S. is on an unsustainable path. Everyone knows that. We're just going to do monetary policy to achieve maximum employment and stable prices, and that's how we think about it.
I'm curious, though, one of the things you're most concerned about is the real economy, what's going on in the real economy. You distinguish yourself from some of your predecessors in that you have a significant exposure to the private sector, not just the public sector, academics. As you talk to CEOs, people in business, what are you hearing about the cost of capital? Because these bond prices are really affecting cost of capital for the first time in a while. There was a long time the cost of capital felt like it was almost zero. And business changes an awful lot when the price of money goes up.
I talked to several people this week who run companies, and they each said that the economy remains strong and that they don't see the consumer. You see, there's some areas where spending is softening, but overall, I mean, look at the retail sales number. The consumer is strong. Volume's not going up very much, but companies are profitable. Now, if you get to where I think the cost of capital would really matter would be for smaller companies and early stage companies, and that really does matter. So we don't have a lot of tools. We have interest rates, and they're far from perfect. It's famously a blunt tool, but it's what we have to get.
Spy above you up there.
And really, the world counts on us to deliver low and stable inflation. That's what we have to do. And at a time like this, we know that we're having negative effects on. We had the home builders in this.
I'm gonna close this call for now.
Time in the whole home building industry, and we know that. But ultimately, what we want to get back to is a long period of price stability. That's the best thing we can provide, and that policymakers and businesses and everyone and people can just lead their lives not worrying about inflation. This is what we can deliver. It's what we have to deliver, and this is the time. Our independence is not for times when we're really popular. It's for when we're doing something that really the public counts on us to do, notwithstanding that it's challenging and difficult, and higher interest rates are difficult for everybody.
You have not wavered from your commitment to 2%. You did again today, 2%. No question about it.
Go to zero any faster?
There are those who suggested, including some
I don't think so.
colleagues in the Fed, that maybe the
maybe if
bond
Ryan
market
Cohen
has done
steps
quite a
down.
good job for you. Is that the way you see it?
Look, I would say it this way. The whole idea of tightening policy is to affect financial conditions. And to the extent higher bond rates reflect that they do, they're producing tighter financial conditions right now. So that's how monetary policy works. That's literally how it works. So again, in principle, as long as bond rates are going up for some reasons, and they're not going up just because they expect us to do things, so that if we don't do them, they'll come right back down. And we don't think that's the case, actually. I don't think it's the case. It doesn't seem to me that's where analysis leads you. Then sure, that's a tightening. That's exactly what we're trying to achieve.
And therefore, it seems like almost arithmetic. It must reduce some of the impetus for you to continue to raise rates.
At the margin, it could. I mean, I think that remains to be seen. And by the way, I'm not blessing any particular level of longer-term rates, but just in principle, that's right.
So let's talk about the labor market. You referred to that in your remarks as well. And as you say, vacancies have come down some, although they still are pretty elevated, if I'm not mistaken. Quits have actually gone up some. It seems to be a tight labor market. What do you make of what's going on in the labor market right now?
Labor market has been extraordinarily strong. So what happened in the pandemic was we had a negative labor supply shock, is one way to think about it. So a whole lot of people left the labor market when the pandemic happened and then didn't come back. And so when the economy reopened and everybody, there was revenge travel and revenge everything, very strong demand, and there just weren't the people. So you had 2 job openings for every person actively seeking employment. We've never been anywhere near close to that. There was panic, and wages and bonuses, and particularly in things like in-person services where people had not gotten big wage increases and didn't want to come back to work. So That's where we were. So since then, there are very many signs that the labor market is getting back into balance, and I talked about some of that in my remarks. Surveys of work, we survey businesses. We don't do it, but other people survey businesses and say, are workers plentiful? And that measure was no, but now it's back to pre-pandemic levels. You survey workers, are jobs plentiful? And that was at an all-time high, and now it's still high, but back. So wage increases are coming back down to more normal levels. Job openings are down from 2 to 1.4. They were at 1.2 in the very tight labor market of 2019. By the work week, by so many measures, the labor market is gradually cooling. And part of that is this, all through 2022, we thought we were going to get more labor supply, and we didn't. And I personally thought, well, I guess we won't get any. And then we've gotten a substantial amount this year. The female labor force participation is in prime age workers is at an all-time high, which has to be related in some way to work from home. But labor force participation increased, immigration increased, and now you see that in the overall cooling of the labor market. So even though job creation is still very high, there are the workers to fill those jobs. And
yeah, you kind of got to wait for him to finish talking.
That it's very different. It's still a very tight labor market, but it's loosening.
Coming back to your goal of 2% inflation, what have you learned from this experience?
Play strangles.
Inflation and labor
before it all happens, but
Phillips curve, whether it's still
got to be set up for that.
What is it? What's your hypothesis right now with the relationship between inflation and labor market?
Well, let me tell you what it was before. So one of my favorite charts is just the slope of the Phillips curve over 40 years. And so it shows the relationship between unemployment and inflation. If you go back to the high inflation of the 70s, it was a very tight relationship. And that relationship went down and down and down to the effect where the Phillips curve, there was almost no relationship, meaning the Phillips curve was very, very flat. Now, actually, if you just ignore cause and just look at the data, it will tell you that the relationship is back. Do we really think that's a sustainable thing? I don't know. What happened, though, was that people came to seriously expect 2% inflation, something like 2% inflation. And if people expect that, if companies expect it, and workers expect it, and you expect that in your shopping, then that's what will happen in a way. And that's what happened. So even in very, very tight labor markets, we didn't have high inflation. I was at the Fed since 2012 as unemployment went from 6 to 5 to 4 into the 3s for the first time. And the models were all saying that we should be seeing some inflation, and we never really saw 2% inflation on a sustained basis during that era. So we learned that the Phillips curve was really flat. Some pronounced it dead. Now, I don't think most of the inflation we're seeing at all is from the Phillips curve, though. I think it was really the collision of very strong demand, really strong demand, with constrained supply. Cars being a great example. Many people wanted cars, didn't want to ride public transportation, wanted to move to the suburbs. Unlimited demand for cars. Interest rates are low. Yet we couldn't get semiconductors, so there are no more cars. Car production went down. How do you solve that problem? Prices just go way, way up for cars. That's how you clear the market. So that's a classic example of what happened here. It really wasn't about the Phillips curve. It was more about constrained supply and demand more broadly, especially for goods at the beginning.
Let's turn to another responsibility of yours, which is the banking system. Last March, we had something of a scare because of, I guess, interest rate risk with Silicon Valley Bank and then some others. Are we through that now? Where are we in that process? Are you resting easy?
So what you pay us for is not to rest easy. We don't do that. But I would say where we are is this, though. Things have certainly settled down. We see the funding markets is fine. We see, and we paid a lot of attention to banks that looked anything like the banks that had the problems, and made sure that they had credible liquidity plans and plenty of liquidity and all of that. And so I think all of that has worked. And we set up this facility that's available for banks to borrow. And so all of that has led to a real settling down. But our job is to be on the case, and we're still on the case, and we'll keep after that. Banks are generally very well capitalized and highly liquid in our country. Banks are strong. We benefit from all those years of reform under Dodd-Frank and Basel III that we went through, with former Governor Tarullo, right, and many others. And so we benefit from a very strong, well-capitalized banking system that's much better at managing its risks than the one that entered the global financial crisis.
Very well capitalized, but you want some more. This is
You're
a
talking about
proposal.
the Basel III proposal, which is, it's a rule that's out for comment, so there's not a lot I can say, but we do expect a lot of comment, and we do expect to take those comments very seriously.
Talk about commercial real estate. There are some concerns out there in the marketplace of what's going on, because obviously there's a repricing that comes with your increased rates. It's thought that there's some real estate out there that is not worth the money that was originally financed with it. How concerned should we be about that as something lurking out there that could really affect the system overall, not just the people invested?
So there's work from home, and that's affecting downtown real estate in a lot of big cities, and higher rates as well, as you point out. So this is an issue that we pay a great deal of very careful attention to. Commercial real estate is not a principal risk or a major risk for the very largest banks. Right. It is much more for regional and really the smaller banks have proportionally a much larger exposure to real estate, so commercial real estate. So what we've done is the supervisors are in there looking at real estate portfolios. They're working with banks to make sure that they have plans to deal with the problems they have in their portfolio. These problems evolve over time. They don't land with great suddenness like a market event. And so we're working with all of the bank regulators are working with banks that have concentrations of troubled real estate to work it out. There will be losses for sure. You can drive down through most downtowns, in many downtowns anyway, and see buildings that are empty and things like that. But we're working through it, and we're on that case, and don't see it as as presenting much broader problems. But our job is to make sure that it doesn't.
As you mentioned, regional banks are where a lot of people focus on this. As you conceptualize the banking system, what is the role of the regional banks? We have the super big banks that don't look like they're going anywhere. And we've got the community banks, the smaller banks that we understand are critical, particularly for small businesses and local context. But what about the regional banks? How much pressure is there on them? And what would the damage be to the system if, in fact, there was more consolidation with some of the big banks?
I think the regional banks are very important, extremely important. We have 4,500 banks, which is a lot more than any other country per capita or per dollar of GDP. But we have, our GSIBs, the largest banks, are the leading banks in the world in profitability and in their success in their business. We have community banks who deal in smaller communities. But we also have these great regionals, and I think they do a great business with many companies, and I do think their business model is under pressure, and I would not like to see us add to that by treating them exactly like GSIBs. I think they don't need exactly the same attention that a GSIB gets. So, but I would say I personally think, and I think we at the Fed strongly think that the regionals and the smaller regionals are an enormously important part of our banking system.
Okay, you've been very generous with your time. Really appreciate it. I have one last question. Are you having a good time? And if so, why?
Now or?
No. I assume this wasn't that pleasant, but in general, are you enjoying your job?
I would say this. First of all, it's an incredible honor to do this job. And every day I do it, I feel so fortunate and so lucky and blessed to be entrusted with this. And, all I want to do is do the best job I can for the public that we all serve. And yes, there's a lot that is enjoyable about it, but mostly it's just so important to get it right, and that's what we're trying to do.
Thank you so much, Chair Powell. It's really good of you. Thanks a lot.
Thanks, David. Thank you.
Well, let me just conclude with 4 thank yous. First, thanks to the team from the Economic Club that organizes these events. It doesn't happen because anyone on the dais does anything. It happens because the team works hard and organizes it and makes it go so smoothly. Number 2, thanks for our audience, both in our members, both here in the room and online. Let me also say thanks to David. You did a great job engaging with the chairman. And I think I saved the best for last. Jay, thank you very much for your talk today. Thank you for the time speaking with David. And all of us say very much when you read and listen to your contribution to the Fed in your various roles. There's only one thing to say, and that is thank you very, very much for your service. Thank you. Everyone enjoy lunch.
Alrighty then.
Far. Now, Jefferies today
Well, they've got something to talk about.
To buy from Powell with a price target of $225 a share. That's up from $170.
GNS.
Saying that while the environment does still remain challenged, they have seen enough positive data to become increasingly positive on some of these
trade
platforms, and that despite outperforming year to date, these companies will continue to benefit from secular themes. They do believe that few cyber names are as well positioned as CrowdStrike to capture federal as well as vendor consolidation and cloud tailwinds. This name, no surprise, has 41 buys of V46 analysts covering it, 5 holds, no underperforms, no sells. So Street really likes this name, and I believe it did touch a new 52-week high earlier in the session.
This one really comes down to wherever you want to start your chart, because if you go back to the highs of the market, November, December 2021, this stock got crushed last year. It went from about $300 at the end of that time frame all the way down
Maybe a
to
little
about
head and shoulders up
100
here.
to close out last year. But to your point, really impressive rally thus far. And I guess thus far, 3 quarters now through the 2023 as it's on its path to recovery, you could say. But if you got in near the lows or even somewhere along the way last year, a good chance that it's been a nice performing name. So still a long ways to go to get back to that 300 or thereabouts level, but a long ways off those lows, as this thing is about $87 off that $100 mark that it bottomed out at.
Right, I would say, 52-week high is all relative. When you zoom out, it doesn't really even seem like a high, but of course, I also agree, good sentiment in the fact that we only have about 3 months left of this year, which to me seems terrifying. But our next name today.
Why is she so scared of the new year?
Now with some positive analyst news.
Don't be scared,
well.
Jenny.
JP Morgan upgrading shares to overweight from neutral with a price target of $220. That's down from $239. Following a very volatile last few months for the alternative energy stocks. They
I'll
said
just
these
buy my
third-quarter
puts
results
vicariously
should be
through
an
you then,
important
Bubba.
catalyst to help buoy better positioned stocks that have been dragged down in the overall space. First Solar is one of these names that has just been so disappointing to follow all year long. It's up now about 1% on the year. It's pulled back about 34.5% from its 52-week high. But this firm does believe that overall industry growth is largely intact as project returns do remain more normal.
At least the IBs come down.
Range is aided by some declining equipment pricing
That J-Pow's
and
done.
continued increases in overall electricity pricing.
We are
For
basically
Solar,
right back where we
particularly,
opened.
The analysts did say the recent pullback
Imagine
tilts
that.
its risk and reward favorability for a company that has the best visibility into the medium-term growth prospects, owing to a backlog that stretches later into this decade. So this name, even though it's underperformed, the street actually agrees with this analyst note that with 19 buys, 8 holds, and again, no bears in this name.
This is a chart that almost, if you spun it upside down, is like the exact opposite of what we just talked about. This is a name that has largely outperformed on a longer time horizon, but more recently has given back a lot of those gains. So like many of these kind of forward-looking industries, it's steps forward, steps back along that path. But really, really volatile name. Peaked out at 232s, down to 153. But pre-pandemic, this name, or not pre-pandemic rather, when the market peaked out at the end of 2021, it was around 125. So it has actually moved higher than where the market had been, much like a name like Nvidia, but it's nowhere near those highs. It's had a huge, huge pullback over the last 2 quarters.
It has, and it's been showing, I think, the divergence in a lot of these alternative energy stocks. It hasn't been like they've been trading in tandem quite at all, frankly, this year. Now, our next name today here is Best Buy. And Best Buy, for so long, I correlate with Bed Bath & Beyond because the tickers were just 1 beat away. But we have no more Bed Bath & Beyond, so now it is just Best Buy that we get to look at today. Goldman Sachs upgrading shares to buy from neutral with a price target that was raised to $85 from $79.
Yeah,
These analysts
it could
see
hit,
the
see
potential
single
for
digits.
a positive demand inflection to now drive upside, primarily through overall multiple expansion. They said their current valuation is not taking into consideration this potential inflection and most likely
See what happens at
factoring
10.
in broader concerns regarding
12 and a
everything
half.
that's going on in the overall market, but they do see the potential for demand to now stabilize over the next year, supported by innovation as well as this replacement cycle, which is something we've discussed so thoroughly with the iPhone coming out, and that there's this replacement cycle where we could start to see this pickup in demand again for various hardware. That has not been the case, though, for earnings, at least. I know it's very early on the earnings season, but I feel like this thought that we're going to see this recovery in a lot of these PC smartphone market, it's yet to happen. So that's a good point, but I don't necessarily agree with it. And this name more mixed among analysts. 4 buys, 21 holds, 1 underperform, and 1 sell. And Best Buy has pulled back about 12.5% here year to date. And I will say electronics continues to be one area of a lot of these inflationary reads, like retail sales, for example, where we're seeing things start to decline and normalize, but that doesn't necessarily mean we're seeing demand.
Right. This is also a name that's lost about half its value since that November, December 2021 timeframe. So was around 140. It's down to 70. But when you start thinking about Best Buy and many of these names in this space, it's been highly disrupted by e-commerce, names like Amazon, but also the idea of companies looking for more direct-to-consumer models, cutting out stores along the way to increase margins. We're seeing this in apparel with names like Nike. Apple sort of operated this way for basically as long as I can remember. Obviously, they do have access to those products in some of these stores, but Apple has its own stores, has its own e-commerce. The one thing with Best Buy, though, is they were in dire situations about 10 years ago. The stores were being used as showrooms for you to go purchase it somewhere else for a cheaper price. They navigated that, kind of reinvented their model, and were able to survive. Still a relatively strong business from that standpoint, but these disruptions never stop. And so if you're looking at these names, trying to figure out, obviously the past isn't going to be indicative of the future. At least one thing this one has going for it in the case of Best Buy is they've weathered this storm before.
It's amazing to me, too, because completely anecdotally, the Best Buy I grew up near was in a strip mall with JCPenney and Sears and Best Buy and Radio Shack. And I'm not even exaggerating. And so 3 of those 4 companies are no longer existing, which just goes to show, that's just how I affiliate this company is being this parking lot of now what is a ghost town of retailers. But that's not to say that that'll happen for them. They've obviously been able to take steps in the right direction to avoid that bankruptcy that so many other retailers have dealt with over the last 2 decades. Our next name today, though, here is Papa John's. And Papa John's is also underperforming this year. It's down 18% here on the year, which when you look at some of these other restaurant stocks, it's not necessarily like they're all getting crushed to this extent. Deutsche Bank, though, today had a broader note on a lot of these fast food or fast casual stocks, initiating coverage on Papa John's with a hold rating and a $71 price target. While Deutsche Bank does have a high conviction in their ability to accelerate their unit growth and improve their margins, near term, they said Papa John's needs to demonstrate its ability to deliver sustainable positivity as far as same-store sales for the stock to work, particularly in North America. They said that their ability to execute on their 2023 unit growth guide of around 5% should help increase conviction in its ability to deliver on its guidance of 5 to 7% growth long term, which is likely not being priced into shares at these current levels. The note was also inclusive of Domino's and Chipotle and McDonald's, but this analyst was much more positive on those 3 names, giving all 3 of them a buy versus, of course, the hold rating they do have on Papa John's. Now, this name has 12 buys, 5 holds, 1 underperform. Average price target, though, is $92 a share, so it implies about 37% upside from where we're currently trading.
Yeah, great ticker, the PZZA. This stock, though, is another example of an industry that's been basically turned upside down over the last half decade. The Uber Eats, the DoorDash, the Grubhub, that push to allow a much wider choice for consumers in terms of what they want delivered for food has really put these names in dire straits in some capacities in terms of growth trajectory. But the pizza for the big group, there's few things that function better than that. So there is a role. It's just maybe going to be a smaller piece of the pie going forward when it comes to delivery.
And fun fact, Papa John's will deliver, or not including delivery fees, but pizza is $5 on Sundays if the Bears win, which we know needs to happen.
And you wonder why they give those deals. So it's not very often that that's happening.
It's very infrequent that has happened, but that is something maybe to look forward to this
Sunday.
Bears. We will move forward with our 2 updates today.
See if I break this
little
channel up here.
We'll be looking at some example
also have
trades
this channel
as well
break.
as some technicals to keep on your radar. Stick around. Next
If we're going to come back down. Okay, little starter on puts there. Breaking that channel. I want to see it break this one as well. Stopping. Probably high a day. Past high day rather. Okay, adding there on that break. I'm cleaning it up. Let's see here.
Price. RSI did drop out of that overbought area here, so that's not a great sign here. But you know, now this kind of gives us a situation where we have to decide what to do. Do we bank on a mean reversion trade here? Do we think price is going to retreat a little bit? Are things kind of overextended, or are we expecting trend continuation? Are
Pretty
we
close to
expecting
VWAP
this to
here.
kind of gear up,
First
break
reward
through
isn't
this
great,
resistance, and start making some new highs? And that's can be a tough question for traders here. There's no crystal ball that tells you what to do, but we can try and use these technicals to inform some kind of outlook here. So, you know, right now, momentum is strong to the upside, but there's a bit of a question mark.
You know what's amazing about this chart too is the fact that we see this massive gap up and then we've sort of held there. I feel like every name we've looked at over the past couple of weeks sees a massive gap down and then we've held at that new range. This is still stuck in a range to the upside. So that feels very unusual given some of the names we've looked at. But so as far as then support and resistance, what are you watching here?
Well, kind of the interesting thing, like what you were saying here, is we had a little bit of kind of this bull pennant type pattern here where we had a big move upward, then kind of this triangular consolidation, then a break to the upside that took us above the original highs. But it failed though, it didn't work out. So that's another kind of situation to consider here as we decide what to do. I think we're going to approach this looking at the upside first because we're up so significantly. We've had such a strong move upward here and we're still quite high even though we are faltering a little bit today. So I included standard deviation channels. We take our blue line, our linear regression line, our line of best fit based on closing prices, then we take standard deviations to the upside and the downside to create these channels. So we crossed above the +1 channel recently. That's a point to look for some support near about the 185 level. If we can fight our way back up through this resistance trend line here, the +2 channel comes in near 207. So not a guarantee, of course, that it's going to make our way all the way up to that point. This is a point where you might expect to find some potential resistance based on this particular study here. If things really fall apart, if we keep moving to the downside, 21-day EMA comes in near 177, then the old highs that we established right here just below that near 172. So, really the point to beat if you're looking at the upside near 192 based on these old highs right here. That's really the important part.
All right, 192, not that far above where we're currently trading at, around 187, just a little bit over there, even slightly down about 0.25% on the session here. So now when trading this name, Alex, perhaps leaning into some of the more optimistic price activity. I know it's been more of a recovery story, less just a story of pure strength, but say looking to lean into that, they do have earnings on Tuesday, I believe October 30th. So we have that to look forward to. Walk us through what you're thinking.
Yeah, when you're looking at this name, I actually had a little bit later date than that in terms of earnings. I think it's November 30th, so you got a little bit more time to deal with. But
you're correct. I'm jumping the gun by a whole month.
No, that's fine. But when looking at this, because we have that time to work with, I elected to go out to the November monthly cycle and buy a 200 call. In order to reduce the amount spent on that particular trade, I wanted to go ahead and sell a nearer dated call to create a call calendar. The reason I selected 200 for this, Jenny, is if you were looking at a little bit longer dated chart, what you would notice if you went back to August of last year is that $200 is where this thing peaked out around that time. So it's sort of our last significant area in relatively recent price activity. So looking for a strategy that would benefit from a move towards that level if it is to continue this uptrend higher. Now, looking at it from a risk-reward standpoint, in terms of the risk on this trade, it's whatever the debit spent was. So at the time, I was looking at this trade earlier, it was trading around a $2 debit. That would be a $200 max loss associated with this trade. Now, with the calendar spreads, of course, we know that they peak out and you want to move towards that strike. So customizable trade, Jenny, one that would benefit from a move towards the 200 strike that we selected, which of course corresponds with that move back into August of last year, and a name that has been trending very, very nicely to the upside.
Right, a name that's been, so resilient, and the chart even speaks to that. Now a name that's been a little bit less resilient, that is Best Buy, and I think go figure. I just feel like the concept of a Best Buy, it's becoming more and more obsolete. Not saying it's becoming completely obsolete. They've held on actually better than I think many would have guessed, but still underperforming. We keep seeing the fact that electronics are falling actually in price, which is good for us as consumers, but Best Buy also falling in its own price.
I can't tell you the last time I even went to a Best Buy, honestly.
Over a decade for me, I think.
Yeah, the last time was helping an elderly person buy a computer, so that
exactly.
That's kind of in a nutshell kind of sums up the situation, I think, here. But longer term, I took this chart back a little further than 1 year, a triangular type pattern here. One long-term trend line going across these lows, another one starting at the highs, converging toward each other with a downside breakout though. And the reason that you want to try to look for shapes like this is there can be an energetic reaction once one of these two areas is breached. Now we had kind of an interesting situation as well because we had a much steeper downtrend here. This blue dashed line you can see that was kind of within this broader triangle pattern, and this is the one that really held true here because we had quite a bit of chop as we were breaking below that downward area of our triangle here. Ultimately, it did play out to the downside. We made some lows even below our previous low point area from May near the 69 level, eventually bottomed out near 67. However, we did break through that steep downward trend line there in blue. We have recaptured our 21-day EMA, and we were below it earlier today here. We were up as much as, I think, 3.25% or so. Now we're up about looks like 0.8% or so, and we are hanging on above that key 21-day exponential moving average. The moving average itself transitioned to much more of a sideways slope here. We were trending down steeply, almost in concert with our downward trend line there. Now it's flattened out a little bit. That's a sign of some improvement here. Maybe not something to pop the champagne corks over, but at least the trend is not as bad as it was before. Our medium-term trend and our long-term trend are both angled downward still, though. So overall, the trend is struggling a little bit here, but sort of improving.
So struggling but improving. I think that's all we could really ask for in the retail space right now. So as far as then the momentum of this improvement, what are you keeping on your radar?
Well, it was looking a little more promising earlier in the day, as we were saying here. We were, as I said, we were up over 3% here. We were above that 50 midline on the RSI. We're just, I think, a hair below that 50 midline right now, just not even a full point below it here. The crossover, a close above that point, would be a bullish sign here. That would be a sign that the momentum is shifting from the hands of the bears to the bulls here. But as we've gotten this drop off today and things have kind of flopped, so to speak, we are also flopping in regard to the RSI improving here. So kind of near the midline, not really giving us a super clear lean one way or the other, which kind of makes sense because we had this back and forth kind of rapid upward and downward price action during the past couple weeks here. But the bulls would really want to see a good close above that 50 midline. Kind of a disappointment today so far.
No kidding. And I mean, even on the session, giving up a lot of that excitement is not exactly what you want when you're a stock that's already down around 12% on the year. But now, as far as some key price levels you're watching, this name also has earnings coming up. We have some time, but what are you watching there?
Well, today, the 21-day EMA is the focal point. I think that's the area that the bulls would really want to see price hold on to. The bears would want to see a close below that level. It's coming in right around 70.40 or so, so keep an eye on that as we head into the close. And a point to the upside that catches my eye here, right around here, we've got the confluence of our orange 63-day EMA with our volume profile point of control, the area of heaviest trading, both coming in around the $73 mark. So you can see that, you know, this is kind of the peak in volume profile right here. We've got this area of very heavy trading where price spent a lot of time. This is going to be probably regarded as a resistance area, not necessarily a hard and fast line, kind of between maybe like 72 to 74 would be the zone to watch out for. To the downside, these two lines that I have right here are old lows near 69 and the ultimate lower point that we reached near about 67 here. So that would be really an area to watch for further downside if we do start seeing price collapse once again. Those are two noteworthy areas.
Right. Okay. So 72 to 74, if we're looking at more optimism, and if, you know, obviously right now we're just already at around $70, which is right around actually where the street thinks things could stay for the next 12 months. We'll leave it there. Really great breakdown as always, Rick Ducat, our chart master. So now I'm looking at this name, Alex. I believe I have this date right. November 21st is when they are expected to report. So we have, thankfully, some time, although that will be here probably before we know it. So what are you thinking as far as then an example trade?
Yeah, I think the mood today, a little bit more optimistic. Goldman upgrading to buy, hiking their price target. But you mentioned that overall street feeling still sort of in the neutral camp, or I would even phrase it as this stock's got to prove it to the street for investors and analysts to really put any more kind of chips in this basket, as it's been such an underperforming name for quite some time. What I'm looking at here, though, with regard to the fact that earnings is in that week of November 24th, going to the week prior, which is the November monthly expiration. And what you'll notice, Jenny, if you were looking at a year-to-date chart on this name, the low on a year-to-date basis is $66.99. Now look, I know that's close to our break-even. I think it's close enough. It's off by a penny. Our break-even at 67 is exactly off by 1 penny. Where the low on the year is. So you're going to need a new low in this stock on a year-to-date basis to break this to the downside. Risk is 4 to 1. So if we do this for 50 cents, the 67.5, 65, put vertical, Break even is going to be 67, 200 bucks in risk, 50 bucks in profit. Needed to stay above 67.5 to capture that max profit at the November expiration date. And of course, it's risk defined if this does collapse and fall below 65. Now, that would be a pretty big move. Granted, it's a $70 stock now, so $5 below would be, just under 10%, but we're getting to, high single-digit percentage decline in just around a month from now.
Right. I mean, that would be a move in this name, but obviously we have several other names reporting ahead of this event, so we could see perhaps some movement if the retail space appears to be more shaky or better than what the street is expecting, of course. But that'll do it for this segment. Now, coming up next, we are going to look at
I moved my stop up on my puts.
one of the biggest stories of the day, and thank goodness it's to the
I got
upside
stopped
as all
out.
things Netflix, as
Took
the
some profit, though.
password sharing crackdown appears to have paid
Take
off.
profit.
We'll discuss more of their quarterly results coming up
40.
next.
Look for some calls on this break. Might add to them on this. $130. I might just want to hang out VWAP the rest of the day. Hop around. Okay, entry. There's limit orders. Suck. Streams are moving a lot, man. We're up 40 cents from here to here. Like stream. It's 433. On the spy. Rejecting that little breakout. Test VWAP. Well, he's not updating my position, so I don't know. What anything about it. Up, down. I'll be happy to not trade on here anymore. I think it's giving me bad quotes.
Held all session long to the upside.
Yeah, well, while we're rehashing history, we can be exact with it. It was the first 2 quarters of last year. So quarter one, well, I'm not sure exactly which quarters they were fiscally, but the quarter that was reported, or when the earnings took place in January of 2022, and when the earnings took place in April of 2022, this stock, just from those 2 points, the day before that first announcement, was just over $500 a share. When it opened the day of the 2 quarters later earnings, it was $220, and it only went lower.
Premium seemed really weird too.
160s. We're talking about whiplash and whipsaw and roller coaster rides. I mean, it hasn't been as quick. It hasn't been today, right, for Netflix. It's been pretty steadily around $400 a share most of the morning into the afternoon. But over the last year and a half, 2 years, I don't know that there's a company that has a market cap in this 100 billion plus range that's been anywhere close to as volatile as this. That includes NVIDIA.
I completely agree. It's that April earnings event that is so still fresh in my mind because it brought the whole market down. And
there's a 40% decline.
It was crazy. So I guess this magnitude of this move to the upside isn't anywhere close to that. But I mean, this name moves, and I think
I below BBBYQ here. Wow.
Can be seen as a positive. It obviously could be seen as a negative if you're looking at it on a day when it's down 40%. But at least we had good reasoning to back
definitely
up
overtraded that area.
Today.
And puts, nice puts.
Which is the main focus for so many investors, came in
Closed
much
them out.
better than expected. At nearly
$8.8
million of this was
out.
way better than what we had been expecting.
Now we just
Blue
chill.
Street estimate,
Let's set
and
up
was
something.
the best subscriber
Or nothing. It's already
growth
130.
ad we've seen since the pandemic first started. So that is staggering to me. The fact they were able to add subscribers at a pace in which they were back when the rest of the world was shut down. I mean, that's amazing. We also saw the fact that they did give some really solid revenue, but going ahead, guidance was slightly disappointing. Slightly. It was pretty much in line with what the street had been expecting. It wasn't all a blowout report, but I just think the focus again was subscribers. And I think you could write almost a master class on the management's tone on this earnings call. Very optimistic, very humbling in the fact that they did admit that they had to encounter some different measures to sort of revive their business model over the past year, but it's paying off. The password sharing crackdown is working. People are not canceling to the extent that we thought they would. Although I will say, we never thought that they would. We were like, this is nothing but a monetary win for Netflix because all of those freeloaders are going to have to either pay or just get off of the various accounts. And it seems like it's paying off. We have seen also rumors swirling for these price hikes. They are raising some of their prices on their overall tiers. We did see that they plan to immediately raise prices for their basic plan as well as their premium plan, which is now $22.99 a month. That is expensive, but their ad-supported and standard plans will remain the same in the U.S.
42% over consensus on that global subscriber ad. That's a massive beat. I mean, this is equivalent to what NVIDIA did to some extent when it was hiking revenue, 40, 50% over expectations. Granted, it's different. It's for different reasons, but it caught the street off guard. That's why you're seeing a 15, 16% rally today in Netflix. But I think, and you kind of highlighted this, you know, I don't think that we take victory laps or anything too often, but I think I, from the beginning at least, have been pretty adamant that this was going to work for Netflix. And there was a lot of people that were sharing accounts, and Netflix is addicting. People love these shows.
That's the thing, is I feel like there was such sentiment on social media, for example, where people were like, I'm canceling, like, forget Netflix. And it's always like the bark is worse than the bite. You have all these people that say, I'm getting off Netflix, I'll never come back. And that never actually is the case.
And then the new Love is Blind comes out, and all your friends are talking about it, and you need to sign up, I guess, is what's going on here with this. But from a trading standpoint, the optimism is, you know, you see it. You feel it in the air around Netflix right now. With the overall market still chopping around, Netflix has
GME
done
near the lows
nothing
of the day.
to give back much of these gains, still over 400 a share. I was looking back over time because, you know, now we're getting back to some of these levels where you can start looking, okay, where did it run out of momentum last time? We're getting back into some of these more frothy territories. And so I looked at back after its first decline in, you know, the beginning of last year, it was able to get back to around 450 before resuming its decline. And this year, it did peak out around 485, but it's really struggled every time it's gotten to 450. So I looked at a strategy that was targeting a move to 450 once again and would benefit from a move there too. And so looking at, we have plenty of time to work with now, no earnings for another quarter. Looking at the month-over-month call calendar at that 450 strike. So selling November monthly, buying December. So this is basically going out till the end of the year. December 15th is the expiration date on those long calls. Selling the November 17th 450 to buy the December 450. 350 debit, so it isn't cheap, but this is a name that moves around a lot. So obviously there's volatility in some of these names. You're paying for that movement, if you will. And so $350 in risk on a trade that will most greatly benefit from a move towards 450. But this can benefit in other ways too. A slight upwards move and an expansion of volatility could lead to an expansion of this spread's price. But we know from the risk profile, best case scenario, a move to 450, and do so not necessarily in short order, but kind of slowly but surely over the next month.
And to appreciate some of this volatility that could be expected, even though this earnings event is obviously behind us. So, I mean, Netflix, it's amazing to me, these swings we can see in this name. We will leave it there for FOMO. Now, coming up next, we will talk the other big earnings mover on the session, although it is not seeing the same degree of price activity. That is unfortunately Tesla. Shares are down just over 9 3/10% now in reaction. We'll discuss more of those results coming up next.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once a client
GME down 4.8. SPY still melting down. Wow, Beyond's down 8.7 today. Breaking through that support. Blue up 3.3, runs down 5.25. Tesla's down almost 10 today. Whew. Still in this downside gap, huh? That's a huge weight on the market. Overstock down 5.8. Has earnings next week. Yeah, next Thursday.
So was this really as big of a surprise as perhaps the price is telling us? I guess you can't argue with the fact that it is down 9%, but I've looked at this report. Nothing to me was a huge shock other than the fact that Elon Musk was relatively downbeat. Actually, Wedbush calling it a mini disaster of a conference call.
Yeah, I think more than anything, the margin compression is not surprising, right? It's still above the OEMs in the space. So that's a positive. And, you know, they've got the UAW strikes. Is he trying to get more volume, right? And then he's talked about a lower price car. He talked about interest rates being a headwind for the consumer right now. You can't buy a car right now because interest rates are so high. So he talked a little bit about that. Maybe that's the overall sentiment that he's feeling in the economy in general. So take that into consideration, that maybe sales aren't going to be as robust. But he did say 1.8 million cars going to be sold this year.
Last thing real quick here, Tom, my question to you, how much of this is a guy that we're not used to seeing downbeat?
Yeah.
As much as people are investing in Tesla, this seems like investment in Elon Musk, you could argue sometimes. And for a guy that's seen as sort of optimistic, forward-thinking, innovative, to have not even necessarily not that, it's not like he isn't confident in the things going, just a little bit more negative, a little bit more non-Elon-like. Do you think that's more the story here than even the numbers?
I think it's part of the story. I don't think it's more of the story. I mean, there's no flamethrowers getting sent out during this.
No shot puts through windows.
Exactly. But that being said, I think the macroeconomic environment's really worrying him at this point. They did put some costs into the production lines also. They talked about opening that factory in Mexico. He's probably going to push back on that a little bit until they get some efficiencies in place. But not a good report. And look at valuations, Alex and Jenny. That's one of the key things I think people are starting to figure out. And I think that's what a lot of people had questions on. Is it an auto company or is it a tech company? Is it a hybrid of that? Because if it's an auto company, valuations have to come down even more than what the stock's selling off today, 9%, because it just doesn't equate to the numbers. But that being said, you know, Elon Musk in the past has figured it out. We'll see if he can figure it out again, but I think it's going to be maybe a quarter or two before we see some more fireworks. Watch November 30th. That's the official launch date of the Cybertruck, and we'll see how many they can produce.
I'm telling you guys, I'm going to get a Cybertruck, and then we can do like a full tour of it. I mean, it could take a few years, but I'm getting one of those Cybertrucks. But good point about valuation. I think that's been the bear versus bull debate for quite some time. But can't argue with the fact that we're down almost 9.5% on the session. Yep. Thank you, Tom, the co-host of Fast Market. Now coming up next, it's time for Under 30. We are looking at Canada Goose as it did touch new 52-week lows in the session. Some downgrades we'll break down with George Tillis coming up next.
the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Missed out on today's market headlines? Get caught up and catch the wrap at schwabnetwork.com. Available anytime, anywhere, on any device for free.
Bought 217 October 27 puts yesterday. Nice, Kevin. Got a good exit on it. Wait, 217 on SPY? What? Why so far out of the money?
Out. I actually think I bought this in the spring to try to like save money. They don't discount really. So break us down your thoughts on this name. Obviously seeing some underperformance.
Well, there's a lot of things you mentioned there that are important because, you know, one, this is a luxury brand,
coffee in
especially
like
their $1,000+ dollar parkas, which are really nice and very popular,
2 weeks.
to say the least. But I think this environment right now has been really challenging for Canada Goose's overall business because again,
AMC
it's a
back down to
luxury
VWAP.
brand and they're selling a premium product at a premium price.
GNS is down
you can actually see that
4.7.
because this company's got gross margins that look like a tech stock. It's around 68%, which is actually very high for a retailer or an apparel
Tesla.
retailer like
Makes
Canada
more
Goose.
sense.
Now it is a luxury brand, but if you look at the stock price, you know, considering seasonality coming up for the winter, it's really been a poor performer this year, and that's to be expected considering, you know, even companies like Nike have been down this past year, some of the apparel footwear companies, because of the consumer discretionary
Look at this ugly
holdback
price
that
action.
consumers are facing because of higher interest rates and
Ben, hold
some
those
economic
puts.
challenges because of inflation. Now, we're looking at the stock, it's been trending lower over the past couple of years or so. TD Cowen actually re-rated the stock. They've actually got a sell from a hold rating, and they downgraded the price to $15 from $22. Now that's above the current price by about $3 or so, and they're actually being conservative, considering again that the company, if you look at its sales in the past year, they're pretty respectable, around 10 or 11%, but that's been down compared to its 5-year averages, which is around 19 to 20%. But I think the earnings growth for Canada Goose is really where there's a challenge in the stock price, because the earnings growth, albeit again around 11%, which is actually pretty good on a relative basis, it's down from about 21% just a few years ago. So it's one thing to actually see some deceleration trends in sales. That has to be offset by better EBITDA growth margins, and that's not been the case here for Canada Goose, and I think that's one of the reasons why it's been under some pressure. The company's profitable, I'll give them that. If you look at the total sales last year, close to $1 billion, it was around $990 million, which again is increasing by about 10% a year, but it's generating about $40 million in net income. Again, profitable.
Butterflies barbecue simply play.
I suggest compared to perhaps the valuation.
Is this
that
the
it's
potential
now,
one
get
that's
interesting because
gonna
if you
get
look
Butterfly
at the
Network?
multiple around 15 times earnings.
Or is that just a
you
total
put
shot in the dark
together
because it's
expected
called
earnings
Butterfly and
growth
it's
of about
publicly traded?
11%. You know, it's still a little bit expensive on a PEG ratio, but it's starting to look interesting here. So I think it's one to keep an eye on. I wouldn't say, you know, it's a buy here, but it's certainly a watch list candidate because they are profitable. They do have a great brand, but I just think that there's a challenge here domestically, but also in China. I think that's where their brands were really popular, and there's some challenges there as well from a growth standpoint, and that's what's putting pressure on this name.
Good stuff, George. I really appreciate that commentary, and you can really see it in the valuation coming down so much. 5-year average on forward PE upwards of almost 30, and you talked about it in that kind of 12 to 15 mark depending on the day. It's really come down, a reflection of many of those factors that you talked about. Senior markets correspondent for the Schwab Network, George Tillis, with the update. Jenny, I was just thinking about this as we kind of close out here. With the Cybertruck and a Canada Goose, what can't you survive? I think you're prepared for the end of the world at that point.
I know, I'm like also building a bunker. I'm preparing for the apocalypse. I swear I'm not. They're just good products, okay? But we believe they're, unfortunately, we're ending the show also with things all together lower, 4 major indices all down, erasing that strength we saw after Jerome Powell was speaking. So ending with all 4 down, but that'll do it for next gen
climbing
investing.
back up to
Of course,
VWAP.
myself coming up next. We have the watch list with Nicole Petalides.
Saving my stamina for maybe one last trade today. Maybe big back green. I was green a little bit, but it was so confusing. I was trading on so many different accounts, different stops. Overall, I think I was green a little bit until this little overtrade in here, which premiums were moving pretty crazy. I don't know why. Happy to be out though. I would not be sitting on a bad trade trying to average in or do something stupid. And there's not much direction. Just building liquidity in a large range. New low of the day there on GME. I can't wait to sell like 8 strike cash secured puts on it at the money. And buying some Jan 2025s. $30 for like 5 cents. Projecting that 200 moving average right there. Wait, the first hand. Ace 8. Jacks and 5s.
Dovish, and the market reacted up, then down, then back up. Here were a couple of the most significant things I read, Nicole. He said, indicators of wage growth show a gradual decline towards levels that would be consistent with a 2% inflation over time. That the market really liked and rallied up. Then he talked about we may not be done raising rates. The market didn't like that, as you know. But then he finished with the long-term rates sitting where they are, up near 5%, is doing some of the work for the Fed and may relieve them of having to raise rates more. So the market, again, liked that, and they rallied. So it was up, then down, then back up, Nicole. A fun roller coaster ride today.
Yeah, we'll see where we end at the end of the day.
Yeah.
I mean, right? That'll be the question. In the meantime, we're also watching earnings. Your thoughts on a name like Tesla, for example?
You know, Tesla was... we knew that because Elon Musk was lowering prices, lowering margins, that their earnings were going to be under pressure. The miss was 66 cents versus 73 cents. The revenue, 23.35 billion versus 24.1 expected. But it had a lot to do, I think, the outsized move in the stock today is about what Elon Musk said about the overeconomy. He's worried about interest rates. He's worried about what he called a stormy macroeconomic conditions, although he did say Tesla is a capable ship, capable of weathering these choppy economic winds. But Nicole, he talked about the Cybertruck. He talked about so many other things. Cybertruck coming out November 30th, but he said it'll be 12 to 18 months before that's positive in terms of cash flow and earnings. So he's concerned about the affordabilities of cars, and he's trying to get the prices low enough because he thinks higher interest rates are affecting consumers' abilities to make that car payment for those cars. So he's extremely worried about the macroeconomic effects on Tesla, and that sentiment, I believe, from Elon Musk is what sent the stock extremely lower.
Or 765
I mean,
rates.
people are saying that's one of the most cautious analyst calls they've heard in years. So real downbeat, but a couple of the guests I had on today still like Tesla for the long term. In the meantime, we thank you, Kevin Hinks. Appreciate it. And the back and forth action that Kevin's talking about, he's absolutely right. So let's get to the bigger picture. Russell Stone's with us, CEO of Scranton Financial. So what was your takeaway? We got some statements from Jay Powell. Did you feel the message was saying that a pause may be in the cards for the next meeting?
It's in the pause right now for the conversation that we're having right now, but they're going to wait and see what happens to the short-term treasuries, like the 3 month and the 6 month. If the short-term treasuries continue to go up, then they're not going to be able to pause. They're going to have to raise interest rates. I personally believe that they're going to have to raise interest rates.
Okay, so you still think they may have to raise interest rates. Why do you think that? What is it, just because the job market is still looking too great? Inflation still worries you?
Look, it's inflation worries me. The rise in interest rates still worries me. People are paying, large mortgage payments on new homes that they're buying. I recently sold my house, and the person who bought our house is going to have to face high interest rates. Those are headwinds. I bought my house when the interest rates were very low. And, it was a great time to buy real estate. I don't think it's a great time for people to be buying real estate right now. And if you look outside the borders of the United States, there's a lot of problems out there between what's going on in Israel right now, what's going on in Ukraine, what's going on in Europe, and the deflationary cycle that's there already. So all it's doing is telling the investors, go with caution, slow down, think about what you do. Sometimes it's better to be on the sidelines than it is to be invested in the market.
So at this point now, when you're saying you're watching the short end, and also as we are seeing, for example, the 10-year bond yield at the highest levels since 2007, where do you think investors should be putting money to work when it comes to the bond market?
My fear is, for instance, you look at bond funds, bond mutual funds, high yield bond funds, and places like that. I would be really cautious about anything that says high yield in front of it that is connected to a mutual fund, because you have no control over the interest rate. You have no control over the principal. You can lose money in a bond fund. But at the same time, individual bonds, high quality, high grade, I wouldn't be afraid of that. I would pull back on the duration and go with a shorter duration as opposed to a longer duration right now, because we don't know where interest rates are going to go. I believe they're going to go much higher because of the fear of default, look at the Treasury market last week. The investor was telling them we want higher yields. And the 30-year bond market last week did not do very well relative to the 20-year, which was a shorter duration this week.
Right. And what about equities? Are you expecting a little pop, maybe a seasonal one, during the holidays, for example?
We had the pop. It started in October of 2022. It's pretty much over with. And now the bull market spirits that drove the market up until November of 2021, they linger. They don't go away right away. And those bull market spirits are pretty much worked out of the system. And now the market is starting to stair step down again. And I believe we're going to see the market just continue to go down until valuations come in line with what they're actually worth. I think stocks are way overvalued.
Wow, so you think the equity market's going to come down? By how much? I mean, when you see the S&P right now, 4308, where do you think might be a good level for it to sort of back up a little bit?
You're not going to like me, but I see about a 50% drop in equities over the next 18 months.
Wow, that's pretty significant. Why? What are the catalysts for that?
Well, you can't run the world on debt. All right. And right now we're at the end of a currency cycle in the US dollar, and the dollar is tired. It's been 98% depreciated. So we're in new territory. In the last 50, 60, 70 years, the dollar had a lot of runway. It wasn't depreciated that much. Now it is. So now what do we do? What options does the Fed have? They don't really have great options. That's why I'm so cautious. I've been talking about this for 2 years on your show, Nicole. Get ready for deflation, because that's what happens in this environment. Deflation takes over, which is really a good thing because it cleanses the markets of the excess debt.
So at this point, I mean, should people take money off the table if they have it in equities? If you see a 50% drop as maybe, right, over the next 18 months, should they sell?
If somebody's got a longer duration, I believe yes. The answer for me would be yes. But if you're 35 years old and you've got a good job and good job security, and you can dollar cost average into the markets the whole time. If you're 60 years old like I am, no, I would be pulling money out of the market, get it on the sidelines. You can make 5% safely right now with liquidity. Why wouldn't you do that until this market figures itself out between what's going on in the Middle East, what's going on in Ukraine, what's going on with their budget? You can't escape the fact that we're $1.3 trillion of new debt is added to our debt load every 3 months. We added $500 billion to our debt load in 18 days. Those are the types of problems that worry me, and that tells me that the investors should be cautious about what they're doing with the money and maybe pull back and let the system work its way out.
Own physical silver first, then gold. What does that mean? Should we buy those silver coins off the television? Sometimes I think about that.
Well, I would. To me, it's good advice because it's real money. It's physical silver, which was really the first bartering metal before gold. But the reason I say that is that you can buy 85 silver coins for every one gold coin. Historically, that ratio has been 15 to 1. So right now, it makes all the sense in the world to load up on silver and then convert that silver to gold when that ratio comes back to 15. I just think people need to have physical silver and gold in their portfolio to protect against a devaluation of the dollar over time.
How would you tell people to buy silver if they actually say, I love this idea, I want to do this? How do they do this?
Most advisors do not work in gold and silver. They're not experts in it. So I wouldn't go to someone who isn't an expert. But I tell you, for instance, most of the people that sell silver, the brokers that sell silver, they sell silver and they do a very good job at it. I would make sure that whoever you buy silver from has the inventory in hand, that they don't have to go out and look for it. That's not good. You want to make sure that they have the inventory on hand. Minted silver versus private minted silver, the premiums are pretty equal right now, so I would go with U.S. minted over private minted. But when those spreads come wider, get much wider, I would buy the rounds, the silver rounds over the minted, personally. But you want to talk to an expert. I buy a lot of silver for my clients because I believe in it.
That's some good advice, and look for U.S. minted. Okay, Russell Stone of Scranton Financial, thank you very much.
Thank you, Nicole. Nice seeing you.
Nice to see you as well. Coming up next, Netflix, Lockheed Martin. Those are some of the big names that are big winners for the earnings season thus far. So what will the fourth quarter earnings season really tell us? We have a high rate environment, much more discussion coming ahead. Our next guest thinks there could be a real choppy waters ahead. Coming up.
Okay. GameStop new low down 5%. AMC at VWAP up 3.5%. Oh, I folded ace jack suited. Whoops. Got a nice flop for that too. Tempted to grab puts here on this break. Did. Just a liquidity grab for the bulls. It. All these going so slow. Slower than usual. A re-raise, really? Why didn't you raise again? Oh my goodness. Literally just called in the showdown. Weird playing. Yeah, I'm out of those. Dang. Gotta wait for a setup I like better. The longs right here. That upper channel. Jeez, this is so choppy. There's like tight liquidity being built, all different levels.
Throughout the global financial crisis. So that is significant. So we do think we need to look
so
outside of the box. If you look in the ETF market right now, a trend that we are continuing to see just explode across the board is flows into options-based ETFs as a way to manage risk. So we have a lot of clients that are looking at strategies like a POCT the 15% power buffer ETF, and they're saying, hey, 15%
Olivia, I can't wait to
downside
not
buffer
trade on this
against
thing.
losses over the next 12
Tomorrow
months,
I should be able to trade on
15.5%
back on
upside if the
TD.
market rallies. That's a pretty good trade-off given all the headwinds that we're
Just
seeing
not
out there
updating my
right
position
now. But all
at
in
all.
all, it is very important to really look outside of the traditional box when it comes to risk
Look at this
management and
tight
return management.
liquidity build.
Yeah, you talked about the recent earnings peak, on average earnings peak 4 months after the last hike. At the same time, flows into options-based ETFs are exploding. Tell us a little about some of these themes here.
Yeah, so, a couple things. When we look at earnings, it's actually very interesting to see how consistent trends have been when it comes to earnings around the Fed hike cycle. And not just peak, but also if you look at when earnings bottom, you look at those last 8 cycles, earnings have bottomed anywhere from 13 to 38 months after that last hike, after the cycle is over. And it really just points to the lagged impact that you see of monetary tightening. You have so many people out there right now that think this time is going to be different. The big question that we want to know is really why that is. So again,
Once it breaks out of this little spot, it's going to be pretty gnarly. Yeah, I'm out.
A good time to be invested in equities.
Stupid whipsawing.
We want to make sure that we have some hedge against losses should the market turn south.
Right. And then you have the wild card, the geopolitical tensions. We have actually Biden was just in Israel, coming back. He's going to be asking for more funding for Ukraine, funding for Israel. And you have tensions that have been very high, and oil right now is at $89. I mean, you can call it 90 almost.
Okay.
Where do you think oil could be headed?
I'm done until we get a break up here.
Turn of
Big
events,
break.
what they could do to our markets.
Catch it late.
Yeah, it's a very important question, Nicole. And if you look at this terrible
Trying
situation
to time it.
that's happening over
Not
in
looking to
Israel
work
right
today.
now,
Gotta get confirmation.
It does have the impact to push oil well north of $100, $125 a barrel, especially if you start to see this conflict broaden out, which every day that goes by where we don't see really a resolution, the likelihood that continues to increase. And what's very interesting
Powell's still
right
talking.
now, when you look at that dynamic, is if we have a situation where that does happen, energy prices spike, and it tips the U.S. into a recession, like we saw in 1973, like we saw
This
in
guy's
1990.
mic is so annoying.
That's inflationary in nature. So the Fed may
Holy
not have
crap,
all of
man.
its tools, policy tools available to cut rates if inflation is running up at the same time. So just more evidence.
Sorry, I just can't handle the clipping. What a catastrophe. Right back to yesterday's portfolio killing price action. I'm thinking I need a break on this, or I want to play the calls. But I don't even know. I thought a break of this, but it's too choppy. I didn't fold. Yeah, I'm not playing a break. There's no pattern here. It's just liquidity and then just falling, so probably not going to go very far. I'm just going to do one of those. Not much conviction in this move. It's not one that I like. $4.25s. From those funny barbecue holders. End of hour rise. Power hour. Maybe. Just wedging for now. I don't know if we're gonna get the breakout today. Straight flush? No. I need to stop playing channel breaks without a pattern. Just sideways and then breaks. That's not confirmation of the move. Jeez. Pocket aces. Oh, the flush. You got lucky with that flush. 7 ace? What the heck? King 2? If a flush setup. There you go. It's maybe coming down, but again, there's no. Yeah. Nothing I like to trade on at this point.
Look at that line. Tell me about the cash flow.
Yeah, I mean, look, we've raised our free cash flow guidance for the
breaking
year
down
from
there.
16 billion or better to 16.5 billion this year, and we're doing that while still meeting all of our financial obligations, whether it's the dividend, we're continuing to pay down the debt on our balance sheet, and yet despite all of these obligations that we're meeting, we're still raising our guidance. So I think the takeaway for us is that we feel really good about our ability to generate that cash.
The low of the day is
More importantly is what we're
427.73.
doing with that cash. We plan to continue to pay down debt on our balance sheet, which is a good thing given some of the commentary that you just had with your prior guest on what's going on in the interest rate environment. But at the same time, we're still investing at a very healthy level. And what that means right now is you're seeing the benefits of that investments today when it comes to our customer growth. But really, we're investing for not just the next 1 to 2 years, we're investing for the next decade plus. Because the way we see things is broadband demand is only going to continue to grow with the digitization of the economy, with great technologies such as artificial intelligence and so forth. So we want to provide that digital backbone to this country. And so investing at the levels that we're doing right now is generating a great return for us right now. But really where we see that going forward is really going to be supporting a very sustainable growth vector for our business and profit growth vector for our business.
Let me ask you two questions. I mean, when you think about, we talk about the iPhone and how that has helped boost free cash flow going forward too, right? Tell me your thoughts on the latest iPhone 15. You know, the questions is this really going to help Apple? Does Apple really have the products to help it to stay, you know, as a leader? And the second one would be the competitive landscape. I mean, there were times that people thought T-Mobile was ahead in 5G or this one or that one. I'd like to hear about how you feel versus your competitors right now.
Sure. So let me take both parts of that question. First and foremost, as you can imagine, Apple is a fantastic partner for us and a fantastic partner for the industry. And so it's difficult for me to talk about specifically about their products, but I would say this, that these devices are the devices that you wake up with, that you use every day, that you go to bed with, and you're continuing to grow that bandwidth and that capability. So as a partnership between us and Apple, we feel very good about that partnership and the innovation that they've created from an industry perspective. And certainly we plan on continuing that partnership going forward. When you think about the competitive landscape, you know, I do want to take a step back because of course it's always fun for competitors to talk about one another and what we're doing. But the reality is right now is this industry as a whole is investing a significant amount into American infrastructure at the moment. So that's really important from that standpoint. The second element of it is demand for services for connectivity continues to grow based on everything that we do. I mean, our lives are lived in a connected world, and we're only finding new and exciting ways to utilize connectivity going forward. So as an industry, I think we're doing a lot of great work. Now, from AT&T's perspective, look, we fine-tuned our go-to-market strategy a number of years ago in meeting customers where they want. As I mentioned before, we're the only really large-scale 5G player that is also going to be a scaled fiber provider. And that's the differentiation by which we're attacking the market opportunity. Different folks have different strategies in how they're leaning in, but really for us, it's providing best-in-class technology solutions to our customers to meet their needs where they want. Best-in-class technology solutions to our customers to meet their needs where they want.
Yeah. Quickly on the dividend, you know, people love to hear about the dividend.
Hello there on SPY.
Well, I would tell you this. We generated $10.4 billion of free cash for the first 3 quarters of the year.
Don't forget support at this bottom channel.
And that's before our 4th quarter of free cash flow generation, which is typically our strongest quarter of free cash flow generation. So needless to say, feel really good about meeting that dividend obligation. And I would say that as we expect to continue to grow free cash flow, the credit quality of that dividend will continue to grow and improve. So we feel very good about that opportunity. But the bigger picture here is we're investing in growth in our company. So certainly you get high credit quality dividend while you're an investor with us. But at the same time, we've got these secular trends that are still on a multi-year basis that will generate growth for our business in the ensuing years.
All right. Any plans to raise it near term?
What the heck?
Just a quick answer.
Well,
just a quick answer.
I appreciate the question. I would say this: we're focused on meeting our dividend commitments and growing the business and paying down debt. That's the primary focus of our cash generation.
Thank you.
That seemed like they will.
Thank you so much for being on.
That smile.
As always, we love having you on the show. I'm glad you came
Interesting.
back to give us some updates and a great quarter. Thank you very much.
Thanks very much.
Still ahead, we're going to talk about how the market is responding to
He laughed.
Chair Jay
Looks like he
Powell's
wanted to
comments on inflation
say
and
yes.
economic strength. We'll dive into some of the charts right after this.
AT&T increasing their dividend, maybe? There's a straight out there. There's trips out there. Not liking it, yeah. Yeah, nothing. All in. Oh, there's another 2 pair. I don't even see it. Ah. Good job, Bubba. Were you green on that? Yeah, that other stupid 2 pair came out. Otherwise I would have had that. You just had an ace. I wondered why my hand strength came down. Wasn't even thinking. From being negative 75% right here to being green. That's all it took. You didn't save any to run? Save any for the homies? With a stop? Perhaps we'll still get a retest on the top of this channel, but not too sure yet. With the queen? Nice. Still able to profit? You're low there on SPY. High still melting down. Very subdued sell-off today and yesterday. Sonic jalapeno cheeseburger, mango slushy now. Watch some Fugazi. It is near. Maybe, I don't. It did break through some pretty big supports. That engulfing candle, which is always a nice signal, but can be false. Well, today was a catalyst for a big move. Whipsawed and like it's decided direction. Might be an ugly Friday, Monday. Very slow and melty though, which I don't like. GME, new lows, they're down 5.6. Mama just got some GME, 1307. Wow, wow, wee, wow.
In on the
C's below VWAP, SPY, new low. Blushing a little bit there. Busted the engulfing candle. Okay, we're not too far away from there. Look for a bounce today to probably get some February puts on SPY. Not a full position in case we do keep rallying. Still have a lot of earnings. Oh, we have Santa rally could be coming. Minutes to power hour. I don't think I'm gonna get that final trade. Dang. Have to end another red day. Bad. Thankfully, I think by tomorrow I should be more consolidated on my one account. At least. It's faster.
Conflict broke out in the Middle East, and I expect that we're going to continue to have a lot of volatility through the end of the year. And I think we're going to see oil going a lot higher. I've said on other programs, I think we could see oil hitting 100 in the not too distant future. So unfortunate for folks at the pump, and probably not what we want from an interest rate fight perspective or an inflation fight perspective, I should say.
Yeah. Logan, let's get right to some of these semis. We know that the U.S. has announced restrictions for some of these chip exports to China. They've already been sort of holding off on some of the most advanced AI chips to China in the first place. What were your thoughts on Taiwan Semi, and what are your thoughts on the group?
Yeah, for sure. So, I mean, Taiwan Semi came out with news. Obviously, they're up today, over 4% now on the stock. And I think the news was, hey, we've had some issues, especially in the personal computer space, computer PCs, as well as smartphones, but it's starting to look better, and the trajectory is starting to look better. Their earnings weren't great. The expectations were very low, but with the outcome that they came out with and the outlook into the future, they really provided some input and said, hey, inventories are coming down with a lot of these buyers of our semiconductors. We think that there's going to be more output coming in the future. That outlook really kind of sparked
the run that we saw today, more so than even the earnings and the revenue that they came out with today, but that outlook looking into the future, and then the hope that those semiconductors are going to kind of bounce back and really have a nice run. I think the reaction to that news shows you that there is some movement in the space, and maybe we have some shifting, and we'll see that throughout earnings reports for the rest of the semiconductor whole. I think there's still a lot of value, about 15, and 15, and then value in this space.
What are your thoughts? Mark has really boosted much of this group, names like NVIDIA and others. You heard from Taiwan Semi. What are some of your first takeaways on this group? And are they divided into winners and losers?
Well, so taking your last question first, they are divided into winners and losers. We've seen NVIDIA just get beat senselessly on the restrictions that the government put on exports of U.S. chips to China. Taiwan Semi, of course, in the opposite position, right? They're selling into the United States, so they're enjoying the inverse of what NVIDIA is dealing with in terms of headwinds. I agree completely with Logan in terms of the value. I think a lot of the technicals that we looked at and a lot of the data that we looked at
Gonna move back to
segment
VWAP
is
for
indicating
close.
that this stock could see $109, $110 if this run continues. If we don't have a major gap down in the market and in tech broadly because of some of the global macro stuff that we were talking about earlier, which in a volatile environment like this is always possible. On the AI side, Nicole, it represents, I think, 6 or slightly less than 6% of Taiwan Semi's current business. So a lot of that excitement around AI is more aspirational than it is actually borne out in their current numbers. But I tend to agree with Logan. I think this is an attractively priced stock, even with the run that it's had today.
6 minutes to
I
power
never
hour.
bet against the growth of data, and betting against Taiwan is a bet against the growth of data, and that's not stoppable.
Okay. And so with that, and you did see some upside potential. Logan, what do you think? Because we have data centers, you have AI, you have autonomous for full driving, self-full driving.
What's up, psych you up?
Do you think
you made it before close.
PCs, some that are more for PCs?
Yeah.
Are there some that are not as positioned as well in this group?
Well, I think that the exposure to the PC and the smartphone space might stay a little bit delayed in just what Taiwan Semiconductor has come out with, and a lot of the other companies like an AMD, and having some struggles in that space. I think if you're going to play this, I like going a different route and trying something different. I think the ARM, actually, after the IPO, it's about $1 below the IPO price at this point. We have still a lot to see as far as earnings go and how they come out with their quarterly reports and different things. But a company with no debt and a huge influence in the AI space as we continue to develop and produce more and more chips and their design capacity. I think that's a good one to play. I also like On Semi and playing something a little bit different in the electric vehicle space that doesn't have as much exposure to the PCs or the smartphones, which I think could still see a little bit of a delay or depression for a little while in a slowdown that could continue.
Yeah, it's great to see you both. Logan Gillen of Jewel Financial, Mark Lepresti of Battlefin. Thank you both for being here. Appreciate it. That's going to do it for us here on the Watch List, friends. Thanks for being with me. I'm Nicole Petalides. I'll see you tomorrow at 11 a.m. Eastern Time. Actually, I won't. But anyhow, I will say that Oliver Rennick, Market on Close, is next, and I will see you there at 4 o'clock.
As recently as what, like 90 minutes ago, Chicago time. So now we're down about 0.75% for the S&P minis. Index about the same, and the Russell, the worst performer. Those small caps continue to drag, and also have been a little bit of a tell. Small caps, a little definite high beta trade lately, giving you a little bit of a heads up as to which direction we're going on any given day. So maybe worth paying a little bit more attention to the Russell, as it has been generally softer. The tech trade has been pretty mixed. There was a lot of support for big tech early on, despite Tesla's steep drop-off from its own chart. Netflix was helping keep positive vibes throughout the mega cap world, but small in market cap compared to the giant that is Tesla. Let's go through it step by step here. Well, firstly, the market's response to Jerome Powell's commentary today, which actually did have a couple interesting nuggets in it. He definitely used a few phrases and some terminology that we haven't really heard him use before, and he kind of tried to play both sides, it seems like. Generally, if you could summarize his commentary really throughout probably the last 3 to 6 months, has been trying to ride the fence, a neutral, and that's been showing up in the odds of a hike by this year, which have spent much of the last 3 to 6 months bouncing between 50%, 40%, sometimes as low as 30 or so, but kind of keeping that uncertainty in the market about whether or not he's going to hike again. I think that continues to show up, and so the path of least resistance for yields continues to be higher, because as long as we know that he's not going to go extremely hawkish and crash the economy, then you've basically got a lose-lose for bonds, as odd as that may sound. That's the way bonds work. The economy is good, stronger than expected, yields go up, Powell stays dovish, the economy is able to find its footing, or if Powell does take it slowly and just stay higher for longer, maybe hike but not cut, that's also bearish for bonds, because it's frankly kind of a dovish position on its own when you've got inflation above the Fed's target and he's not going to press it even harder to fight it. So seemingly the message
Sorry,
from
Psych, I didn't even see it. Happy
Mulan
chums.
bonds are going to sell off.
I like it.
Chop throughout the day.
Not
Treasuries
song.
weren't exactly sure where to go, but they definitely were
Not
sure
song.
last night as bonds sold off. And so now we're back pretty close to the lows of the last 24 hours in bond prices. And with that,
Setho,
we're also
Africa.
at the lows of the day for the NASDAQ. So
Setho?
you can see the way they're both getting
Like a
jostled around.
province or
with the
something?
same
I've never heard of that
forces
country.
At the same time. This is not a mystery at this
Region.
point, even though much of the last year,
I did get some calls
stocks
there.
were able to go up even as yields were pushing higher.
I guess a bit of
It's not
end of
the
day
case right
lotto.
now, since bond
Gonna
yields
move back to safety.
really blew out to the upside in the last 3 months. Stocks have relinked with a
Premiums have
negative
been weird on me
correlation.
today.
Yields go up, stocks go
Not just
down.
like elevated,
a
but
positive correlation to the price of
I
bonds.
think I'm getting
Bonds go down, stocks go down.
I think I'm getting
There it
bad
is.
quotes
Let's
on
look at the
Fidelity
dollar next.
actually.
Greenback down. This is where the message about not hiking does come through, and which also keeps stocks in the game, because even though Powell's not going to cut, he does not seem eager to hike either. And so the dollar remains very range bound and actually a little bit soft.
I'm getting bad fills, I think, also because I'm having to limit order everything. And so to make sure I get in, I just put it way over the ask. Should be getting at least at the ask, but I don't know if I am or not.
Not inversion, and a soft-ish dollar because the Fed's not going to go super aggressive like they did in 2022. So this is an environment where
Thanks for hedging me, man.
Survive. They don't have to necessarily get pummeled like they did last year if the dollar's not going to surge and the curve's not going to invert. But that's just a theory. Right now, what we're learning
I could just jump out of these two.
The last 3 months, equities don't really care about the details behind why the yield is going higher. They just don't like the competition for investors' money that bonds are obviously presenting at this point with yields this high. 5% on the 10-year is changing the stock math. What's also interesting, too, is that investors are trying to dabble with some risk on. Bitcoin's been higher, and it's got a nice little move going. Maybe that is some of the ETF stuff lingering, but also look at gold, too, as gold's been picking up the pace. Bitcoin and gold
Close
actually
another
trade
one there.
quite differently,
Could just
so
be
I do think there is some
bear
tension here, but I
flagging.
bring it up because there's just a good bit of tension in the market overall. So gold really ramping up seems to be tied to some of the geopolitics.
Fidelity.
More headlines about maybe knock-on effects of turbulence in the Middle East, and gold is catching a bid. That's happening even as yields are moving higher, which is usually what sends gold lower. So there's another example.
Doesn't seem like this
of
is
where
the
there's a lot of
bottom.
tension
I don't
in this
know.
market. Some of the
Moving up
stuff
so
just
slow.
doesn't add up here. You can now decide as an investor or trader where you see the most conviction, and to me, it's in the bond market. So if we use that as our baseline, gold kind of looks a little bit out of whack and very much attuned to the geopolitical stuff that hopefully will be short term. So it could be a cautionary note on how you trade gold to the upside. Bitcoin, the same story. Maybe that's keeping bid because of the ETF potential, but when you look at the rest of risk assets, which eventually Bitcoin generally joins in the same direction, they are under pressure. The chip makers are having a decent day because some of the reports came out better than expected, but the numbers are still not impressive, and the semiconductor ETF eventually rolled over, which I do think makes sense based on what we saw from the numbers of these companies. Outside of NVIDIA, there's still a lot of contraction in the chip world, and then also Tesla too. The breakdown there is usually a sign of where risk
Tesla's down like
appetite is
10%
flowing
today.
in the stock market. And you can see my triangle here is starting to get violated by this weekly candle. So yeah, there's a
Highlighted
lot
triangle.
here. I got Kevin Hanks here with me in studio. It's a little bit messy, Kev.
You know, forgive me for a counterintuitive look, but from a trading perspective, from a trading background, you love days like this.
Sure, yeah.
They're all over the board.
Nice flop.
You buy them, you can sell them, and at one point you're right on both.
Yeah.
But from an investment, you know, Jerome Powell said mostly good things that the market should have embraced, and it didn't. Right? Now.
Tried.
Yes.
We had a big rally
I mean,
there.
the 1 minute, all you got to do, hit up the E-minis or the SPX and throw in the 1 minute candles.
Yeah.
They are harsh and big moves. Right when he started talking, they spiked. They let him off stage, they sunk. He came back, they spiked again, and then they hit hard.
That's right. I forgot about the protest.
Yes.
Like if there wasn't enough already today, that was messy.
Exactly. So Jerome Powell said some things. I thought here was one significant thing that he said. But he
This
said
looks
a lot
like
of them. I've
bears
got
building liquidity.
1, 2, 3, 4. I've got 6 things.
Too early for the end of day bounce.
Indicators of wage growth show a gradual decline towards levels that would be consistent with 2% inflation over time.
That was a big one. That's the most dovish
That was
thing he said.
that was early. That was when they spiked right off the
stocks
bat.
loved that.
Loved
which
it.
is essentially based
'Cause
on the last
wages.
employment report, which you talked about ad nauseum when that number came out. And even though he's data dependent, I'm kind of surprised that he used that one piece of data and wielded it as strongly as he did in that statement.
Because the looks at inflation, even though we've got, and we report on this network every day, a big dose, a big flow of positive economic data, it's not in the inflation numbers.
Okay.
It's in the other things. It's in industrial production. It's in all these other, it's in the ISM numbers, but it's not in those key 3 levels of inflation, wages, CPI, and PCE. It's not showing up there. And that, I think, is giving Jerome Powell a little comfort.
What's interesting is the way the stock market traded so strongly off that, because it is a perceivably dovish comment.
Yes.
But at the same time, none of that means he's going to cut.
No.
Wages not spiraling out of control is not why you cut rates. So I think the market still has this knee-jerk habit where they go, oh, he said something kind of dovish and accommodative. Let's price down the rate futures. But then it's like, okay, we actually can't price him down because he's still not going to cut. He may not hike. But
thus, comment number 2. The evidence is that policy is not too tight right now.
Yes.
There's that one caused some concerns.
That was a little bit of a blow to the narrative of lagged effects.
Yes, exactly right. So there's the other comment. I used to comment a lot on Janet Yellen when she was Fed chair. She used to really balance her statements, almost like a game of 3 up and 3 down. He was kind of doing that
so
today.
flip-floppy.
He was doing a Janet Yellen impersonation, but he kept saying, here's the other thing I liked. Long-term yields are showing to be a substitute for further tightening. Market liked that too. Mm-hmm. So there's another comment that he made.
Yes.
Listen, I thought he was broad. He talked about a lot of different things, and you could see the 1-minute charts, what it did to the overall markets. They reacted harshly, both up and down.
I feel like that has been his tone for most
I'm
of
out
this year,
of these.
which has been riding the fence, basically, and keeping the odds of a hike within a reasonable range around 50 or 40-ish so that he doesn't totally unveil his cards to the table. But at the same time, I think the bond market also sniffs out the notion that if he's not going to be on either extreme, then we probably get higher yields. Because if he's not going to overhike and crush the economy, which he's definitely not.
Not going to. His legacy demands that he doesn't.
That is that's like the one possibility we can almost be certain he's not going to do right now. Because if he had that tendency, he'd be doing it already with inflation above his target.
Closed a couple for a little profit, but
so we know that's not going to happen.
Didn't make up for the loss of closing here.
And then all the
Premiums are
economic data beats expectations. So it seems like the best bet bond traders have figured out is, well, just sell bonds.
He can't cut rates until, without an event. Of course, we always have to premise without some type of economic shock, an event. He can't cut till he see the whites of 2%'s eyes.
Yeah.
Right. He can't because they'll accuse him of going too early and they'll accuse him of reigniting inflation.
The other point too is that the tightening that happens by the bond market organically through its own selling, even though that might be music to investors' ears, we got to be careful with that one too, because that basically means that if the bond market just keeps running, he's not going to have to change to something dovish until the economy tightens by way of probably the stock market.
Yeah, the quiet thing that no one's really talking about, or very few people are talking about, is the supply of bonds that the U.S. government has to sell in the coming weeks and months. It's not going to be a small number, and the last couple bond auctions have not gone well.
Yeah.
So that could be another problem for yields over the long term.
Indeed, that was the big point of Zed Francis this week, telling us that that's where the big expansion of the term premiums coming from, that the government is now an introducer of volatility.
Yeah, pounding away on, and more supply coming on the market without the Fed buying.
Yes, correct. Or the Japanese as much.
Yes.
So, all right, we definitely get a very persistent trend. So in terms of the different asset classes, some of them being at odds today, one thing is clear. Bonds have chosen their direction, and it's very hard to stop them right now, it seems like. Thanks, Kev, for the analysis. Good stuff there on the thoughts from Jerome Powell. Let's bring in Ken Moore-Rafe. Been around the block as well. He's the CEO and Senior Financial Advisor of Retirement Planners of America. So, Ken, in a couple different statements from Powell, it seemed like he kind of veered on both ends of the spectrum. What do you think is the big takeaway now that we see stocks down alongside bonds again? Basically, 3 months running, this painful correlation has been dictating the market.
You know, this makes me feel like John Travolta in Welcome Back, Kotter, when he said, "I'm so confused." The discussion you guys had was just fantastic. That was very interesting. Thank you for having me on.
Absolutely. Thanks, Ken.
The Federal Reserve is going to let the market do
GME flushing there, down 6.5. Broke $13.
So what you guys were saying, I agree with entirely. The Fed is not going to tell us they're going to lower interest rates or even give a hint of that, because the moment they do, interest rates in the market will start going down immediately, and that's inflationary. So they're not going to, as you said, until we see the whites of the 2% inflation's eyes, it's very unlikely that the Fed is going to tell us that they're going to lower interest rates or even hint at it. we've been out of bonds since April of last year.
I get no calls in every hand.
Because of what you were
I even
just
did a
describing,
smaller
and
bet
that is
thinking
that as interest
only
rates
aces
go
or
up,
kings would
bond
call.
values tend to fall.
Maybe nines, fours
Believe it or
there.
not, this
Yes.
is actually the
Come on,
worst
raise
bear
it.
market in bonds since they've been recording bonds' performance.
Oh, wow.
1787.
Measured by what? That's a great stat.
I'm sorry.
It's the length of the
small
length,
bet.
the intensity.
It's
No
the intensity,
aces?
yes. If you go back to April of 2020, the aggregate bond index is down over 20%.
Finally a call.
That's unbelievable.
It is.
So right now, what we're doing is,
getting,
and again, we work with
my
people who are over
good hands
50,
are nothing.
retiring soon. So
Get no
our
value on
clients
them.
are more conservative, and so we tend to be late to the party. We tend to leave early. But right now, a money market fund for our
About to
clients'
break the
bond
low probably.
allocation is the place
I
for
just
us
didn't
to
want to
be.
take
Right
bets
now,
at this
money
point.
markets are making over 5%. And why
But I
would
gotta
we
have my
get
calls
that
the right
without
time
the
at
risk
least.
of the Fed raising interest rates some more and bonds getting killed some more?
Let me, I guess, give you an example.
I don't like the risk reward down
folks
here.
I talked to at our market drives.
Not coming to end of day with VWAP up there.
Of clients. A lot of them will come up and they'll say, hey, I've got pension money I just got. What do I do with it? I don't need big returns, but I also don't want to lose it. I want to be able to give it to my kids. I want to be able to tap into it on occasion once a year or so for vacation, whatever it may be. I mean, is the best trade then to kind of like sit in a 5% yielding coupon and reap that simple reward without taking risk, or is there too much principal risk in that trade with the way bonds are going?
It's just bears building liquidity. New low there on
If I was
SPY.
talking to a client and they said that to me, my question for them would be, do you want, essentially, if you're only going to touch this once a year and you don't really need the money, then what you're doing is you're investing for your heirs, right? You're probably going to leave it for them to inherit from you. And if that's the case,
AMC is only up 1.5 now.
You can invest it as if it was for the kids. But I wouldn't go more aggressively than 60% in stocks in today's environment. But I would have, it would be a 60-40, but the 40% right now we would have in the money market fund. And we consider cash to actually be an asset class. I know most people don't think of it that way, stocks and bonds and this, that, but cash we think is an asset class, and it is a viable investment choice at different periods. And right now for the bond side of the portfolio, we think it is. Now for stocks, we are bullish going forward.
Okay, so for stocks, the exposure that you still want in your portfolio, if you've got a bit of a longer term horizon, should be there. But what about the valuations when we compare to bonds? I mean, is the goal to get a big boom in the stock market, or is the goal to just be in equities that are going to be less sensitive to rates at this
little icing
juncture?
on the cake. No runners, though. You got to leave some runners, man. Leave one for the home heat.
When it seems as long as rates are up or moving higher,
let at least one contract stop out.
Yeah,
trailing stop.
The stock market
annually trailing
is
stop.
a forward-looking mechanism, and investors tend to look 6 months into the future. Historically, the stock market starts to go up 6 months before the recession is over, and starts to go down 6 months before the recession starts. So it's looking into the future, and right now, and profits are what the stock market wants to know.
GME hits 10 next week.
It's going to go down, go up, and that generally drives where stocks go. So right now, investors are looking into the future, and the biggest driver right now, the biggest variable or what could cause profits to go down is the Fed. So if we look 6 months into the future and we say, 6 months from now, do you think the Fed will be done with this interest rate rising cycle? I think most people would say that there's a high probability that that'll be the case. So if that's the case, if the Fed will be done, then the risk to profits, therefore, will be off the table, and we see a rally coming. So when will that come? I think we have to get past December's meeting, because November, I think right now is a given. They're not going to raise interest rates. But in December, there's still that uncertainty, and so they might. But once we get past that, stocks should rally. So we're looking for a rally into the end of the year and into the next year.
The logic that I keep running up against with the potential for a big rebound in equities.
Chopping to close. Yeah, it could be. We might not get that bounce.
To the end of the hike cycle, if there's no cuts on the other side, how do we know what the math looks like after everything we went through COVID, the kind of experimentation with zero interest rates, the zero bound? How do we know what it looks like if we're not just higher for longer, but like maybe forever?
Wait for a break on that channel.
Everybody thought lagged effects
I'll
were
rip
going to
out
be
there.
beating this economy up long past where we are right now in October 2023. And people thought the market was pricing in cuts at this point. But it's like you just can't keep the economy down. I don't know if it's stimulus we still got swimming in our veins from COVID or what. But what if it's not just higher for longer? What if there's no cuts unless the economy really, really tanks, Ken? Because that wouldn't be good for earnings.
You're right. Earlier this year, starting in about March, we were saying that inflation would bottom in June around 3% and then start rising again into the end of the year and probably would peak in December around 4%. Which is exactly what's happened. We were never on the bandwagon of the Fed lowering interest rates this year. We just didn't see how that could be possible. We also, for the reasons I was talking about before, we don't see that the Fed will be lowering interest rates next year, again, because getting it down to 2% is going to be tough. And Powell was very adamant today that they are going to get there. So they're going to fight that fight until they get there. He's not mincing words about that. However, we don't think they'll get there by the end of next year. We think that inflation will probably be in the 3% range. So therefore, they won't be lowering rates next year. But again, remember, the market investors are not looking what's happening right now. They're looking. Inflation will probably be in the 3% range. So therefore, they won't be lowering rates next year. But again, remember, the market investors are not looking what's happening right now. They're looking into the future. And so if they see that the Fed is getting very close to that 2%, then they're going to start investing and the rally will come ahead of that 2%. It's not going to wait for the exact moment that we get to the 2%. And by the way, I got to say also, we're talking about stocks, but I got to tell you, it is possible. If you look at the trend of the bond ag, it's basically gone steadily down over the last 3.5 years. Mm-hmm. And the reason why it's gone down steadily and not dramatically, it's just been a steady downward, is because every step of the way, bond investors and the market and everybody was saying, no, the terminal rate is 4%. No, it's 4.5%. No, it's 4.75%. No, it's 5%. Nobody was willing to say it's going to get higher than, whatever. But when the Fed says we're going to lower interest rates, it's very possible we could see bonds recapture almost all of the losses it's seen in short order. So that's the second half of next year in bonds could be pretty amazing is our view right now.
Well, I think it's a very helpful and clear kind of if-then analysis. If you start to see meaningful moves down to that inflation target, that's when you pounce basically on kind of gearing for that sort of comeback. And it sounds like you think we will get there after this year. And so far, the inflation view has been pretty darn good from our last conversations, Ken. So good to catch up, and thanks for the framework. Always very helpful. Appreciate it. Interesting perspective.
Thank you. It's always good to visit with you.
Absolutely. Appreciate it. Thanks, Alan. Ken Moray, Retirement Planners of America. All right, in the background, of course, we got to talk China, too, because the data there has been a little bit better, but stocks still aren't responding. We'll be back to talk about the region's recovery after a long, sluggish post-COVID period that seems to be turning up, but not so much for...
I don't know what that is. It's flash crashing or something. Happens about this time of day. AMC was holding up really well. Still up 1.5. How bad small caps are doing in the whole market? Yeah, I was up 9% earlier. That's right.
How you view the economic potential of China at this stage?
Well, obviously, it's been a really tough year in China, and the Chinese government thought that they could kind of organically grow their way out of the zero COVID that ended this January, just by teasing stimulus measures and opening up the door for foreign visitors and business travelers. That obviously hasn't had much of an impact. And this kind of drip feed of stimulus measures with all the negative noise in the ecosystem, be it U.S.-China geopolitics or the real estate bubble and so on, has further undermined investor confidence. And so we've not seen the kind of uptick that maybe they were expecting they'd get. All of that means to us is simply that there's a lot of dry powder now to be fired by the government as they look to stimulate the economy coming into the end of the year.
I like the way you put it, the kind of drip or the tease of stimulus. How come they haven't fired that bazooka? I mean, I think a lot of people thought that they would be stepping in much more than they have already.
Again, I mean, I think that they really tried to have a fairly conservative fiscal policy. You know, that's what they thought helped steer them through the GFC last time around in 2008. And so they really haven't, we've been maintaining kind of 3.5% interest rates. They haven't really injected significant capital into the economy in the form of stimulus. Still a lot of real estate firms that need to be kind of bought out or reorganized. And so overall, I think they were just hoping they could do it in a more conservative fashion. Hasn't worked. And so now they're really going to have to turn on that engine or we're just going to lag.
Okay. So the data so far, does that make them feel good that perhaps they don't have to give a big fresh wave of stimulus?
So now is a kicker, the kicker win?
Week, but obviously you study this more than I do.
Look at how they split this up. Just a tie.
Impressiveness here.
Yeah, it's the kicker.
Oh
no, you had a higher one.
Rooting for
Jack.
lower numbers actually in the office, hoping that would give them an excuse to go a little bit harder on
An RSI divergence down here.
But
we got to break some
still,
Miz resistance channels.
Not overwhelming numbers, beating estimates, but and I'm sure that come hell or high water, will finish the year within their target range, as always happens. But I think in terms of the true outcome in the economy, it's going to necessitate some of those stimulus measures. They see it, they feel it. They see the capital outflows, the exodus of global investors from the market, the manufacturing numbers down, export numbers down. So it's still clear that there's still a long way to go to get back to the pre-COVID levels.
It seems like the market was also rooting for some bad to be good, as you put it, because we're at fresh lows for the past 52 weeks in terms of big cap China. As a result, the fund you guys launched, 3 days ago, is under some pressure too since the beginning. Tell us about how you construct this, because I see it phrased as an America first China equity investment. How do you balance America first when it's all China?
So obviously it's still
30
American
minutes
to
to
make money.
close.
There are many of those that still would contend that China is a good investment opportunity and one that if you steer within certain sectors is not controversial. Even I think members of Congress and the executive body would tell you they wouldn't want to
bouncing
ban
off the lows there.
Investment into China. And
Front running SPY a little bit.
A quarter or a third or half or more of their revenue in China. Big names. And so it's still critical we maintain that economic linkage. It's relatively undisputed that China will remain one of the world's largest economies, if not the largest, over the coming years. And so what hasn't been done, what we think is novel about our approach is none of the other large ETFs looking at China have done so through an America First lens, which is to say access that China alpha without investing
slow
into
play this
businesses
queen.
that, one, compromise
someone
American
raise.
national security interests. 2,
No one?
compromise American core values. So companies that have some connectivity
Yes.
to repression of human rights, censorship, etc. And then 3, companies that are obviously going to really challenge the kind of supremacy of American technological and economic leadership. And we actually found as we built out the portfolio that there is a robust number of assets out there that are in non-controversial areas like consumer discretionary or robotics and efficiency drivers within the Chinese economy that can still drive higher alpha than what you'd probably get on an index fund. But you can do so without having to
Yeah, I'm
answer
grabbing
to
some
your
calls there.
investment committee or your shareholders that you're somehow finding your way into some kind of a company that might have a chip, say, that has a dual use between civil and military fusion.
Got it.
The results speak for themselves.
So you're basically trying to avoid the potential conflicts that might arise when there's basically an incessant U.S.-China effort to kind of like restrict one another from classified stuff. I mean, it's like every other week we get a new headline. I'm curious how much you can tell us about the Taiwan earnings real fast. Is there anything that stood out from that report? Because the market seems to be giving them the benefit of the doubt here. Got about 60 seconds.
Yeah, it's clear that people, even though they missed the revenue numbers, I mean, this is a stock where we have about 5% of in our portfolio. They still make the most advanced manufactured chip available on the market. NVIDIA rely on them, Apple rely on them. There's no
Am I
replacement
wrong
for
that it's
them in the supply chains.
it's
And the other
NVIDIA
ETFs in the
and not
market
NVIDIA?
that we're competing against in the China
Is
space
it a
don't
is it an
carry this
I
stock
there,
because they
not a
track the
not an
CSI
N?
index, which only looks at Chinese businesses. So we fully believe that this is the future of chip manufacturing.
Greater China,
NVIDIA.
they're playing a role. The title there is you can look beyond the companies
Okay,
based
I'm
in
not wrong.
mainland China. Great convo, Ben. Thanks a lot. We'll definitely be in touch. Looking forward to talking more about the region with you. Ben Harburg.
I just don't know why I can't say it wrong like everyone else.
CGRO. And right in time, Mr. Tom White sits down with me to trade some Taiwan semi. Okay, we just kind of heard the explanation for why the market's liking this here. Shares are still up despite the rollover in the broad session today, Tom. What'd you see in options?
A lot of activity as far as
a lot of activity.
go. On a typical basis, we don't see a ton of volume in here. Call volume is about 6 times normal daily average volume over the last 5 trading sessions. So you're seeing people pile in here with the stock up 4%. I mean, if the market was flat, up a little bit, can you imagine this stock would probably be up 6-7% on the session today. But chip recovery, they highlighted that. They upped their guidance, and so we saw some call buyers come out of the woodwork in here, and they were buying deep in the money calls.
These calls are for
So
tomorrow,
this is out
not
in the
dailies.
February cycle, so giving themselves about 120 days till expiration. They were buying the in-the-money 80 strike calls.
Ooh, breaking the bank.
Yeah, breaking the bank. But there's a reason that they were buying the 80 strike call, because this trader, there was big open interest on the November 80 strike calls. They sold nearly 20,000 of those, so they got out of their position in there, and then reloaded on that same strike in the February cycle, so giving themselves 4 months.
I've never heard anyone say
trader,
NVIDIA
almost 4 months, where they bought 21,000 in the Feb 80
I don't
calls.
think on
They
any
paid a hefty
program.
premium,
I've only heard
16.55
NVIDIA.
average debit. So that break even of 96.55 over the next 120 days, that's only about 3.5% above the current share price. So you don't need that much more room to the upside while still giving yourself that huge duration. But selling out of the November 80 calls that were a winner for them, obviously, with the stock up over 4%, and reloading out in longer duration.
You want some
options.
safety? Huh?
Okay. All right, so that's pretty darn bullish. So I guess that they are indeed finding the silver lining in this report.
Yeah.
You know, when I looked at the numbers at first glance,
I think you're gonna make it.
I would have bet that the stock would have been down today.
Pretty cool.
I know that like there's the element of beating and talking about the trough turning around.
Yep.
But just hard for me to see how the whole AI expansive narrative is not starting to show up. It wasn't ChatGPT unveiled a year ago, like yesterday. So it's been basically a year, and we only have like one chip maker clearly benefiting from it at this point.
Yeah,
so,
I think some of the key things, and this is why you have to monitor conference calls and stuff, because inventory levels bottoming out here. They expect that by the end of the year. And then also it's the specialty chips that they're doing where they bank better margins on it. The smartphone market's starting to turn around You met your last guest mentioned Apple, Nvidia. Those are customers that have massive demand right now. So with the higher margin chips starting to sell and a bottoming out in their lower margin chips, with the expectations that those are going to grow into 2024, that's the reason I think you're seeing the strength.
And I get that they're still like one of the biggest providers to the more
sell a couple
cyclical
here.
kind of personal device category.
Mental profits.
And, other obviously commercial build outs too of all the data center and tech stuff. But as far as like the main valuation driver of the sector, it just doesn't seem like it extends far beyond Nvidia, because all these things you're talking about
This guy raises huge and he gets multiple calls.
Macro cycle
have an ace?
still is not about like big growth, which is what I thought we were supposed to start seeing by now across the sector. I thought they were promising like the trough 3 months ago, but all right.
That might be here. If those inventory levels dissipate like they said that they're going to,
sure, then that helps.
Maybe that does equate to higher move today.
How about Intel?
A break even
which
stop on the rest.
A great year, a comeback year for sure.
And
I do
maybe
feel like
not
this
doing
one
it.
is the exception to what we're just discussing here, because it's so stock specific at this point. Was so destroyed for multiple years. People forgot that it even has such a massive exposure still to so many industries. I feel like this is like in a world of its own.
Yeah, data center, the PC market supposed to be bottoming out also.
Right.
I mean, I don't know if those numbers are correct, but a lot of these companies, whether they're chip makers or whether they're the fab makers for the chips, they said that they've seen an uptick in the cycle, that we have seen the trough in this particular space. Intel's up today, probably on the back of the little rally that we're seeing in Taiwan Semi. They're going to be a leading foundry in the future for a lot of these chips also. But as you mentioned, stock's up 36% year to date. They do have earnings next week, next Thursday. So keep that in mind. That might be a catalyst for this. Maybe somebody's setting up here for some potential gains here post earnings. Notebook shipments were up 7% month over month in September. That's well above what the estimates were on the street. So is that bottoming cycle in where Intel, AMD, Taiwan Semi, they can start doing even better? And we've seen the stock moves. And we saw an uber bullish trade in here, Oliver. I know you'll like this one. And they did a combo or a risk reversal type trade where they used a short put to finance a long call. And this was out in the December cycle, so giving themselves about 57 days till expiration. They bought the at-the-money 36 strike call. They sold 4,000 of the 36 strike put. This combo trade, they paid a debit of 22 cents because you offset some of those costs by selling the put against it. But that break even is 36.22 over the next 57 days. That's less than 2% above the current share price. You can see there on the risk profile, it looks like you're just buying the stock, right?
Right, yeah.
But that's basically what it is. It's basically 100 delta selling the put and buying the call. That's equivalent to about 100 delta. So it's going to react just like the stock. But somebody, thinking that, we're going to see some more upside in here over the next 2 months. And that earnings event next week will be a catalyst.
It's a fun way to play Intel.
Yeah.
I respect it. Definitely bullish, but with a little
That
bit
gives you
of
100 delta. Not thought about that.
Spin on it instead of just buying the shares, playing the volatility a little bit more. Last one you got, American Express, which is down near the 52-week lows right now. All the credit cards got hit, regardless.
I think that's a play you do pretty often, huh?
Which customer?
Yeah, and they got earnings
I've done cash good puts and long calls,
seeing some unusual
but never both of them right at the
activity in
money.
there today. Option market's pricing in about a plus or minus 3.5% move in the shares. Now, if you look at this on a valuation basis versus Visa and MasterCard, right? American Express trades at just 15 times earnings, a steep discount to
22 minutes to close.
To some of their competitors. Visa's at 30, MasterCard's at 37. Now, they do have a loan a business where they hold assets also, so maybe there's some concern on that segment of their business going into these earnings results. We had Folio on Fast Market today talking about this stock, and they're seeing continuation of positive sentiment from the consumer.
I just got my corporate card delivered, Tom.
There we go.
Just kidding.
Keep it in your pocket.
Just kidding.
Keep it in your pocket. But that being said, earnings tomorrow, big catalyst. Option market's expecting that muted move, 3.5%, but they were in there buying the October 20th 155 strike calls. They bought over 4,000 of those, average debit of about $1.15. So that
Stop out of those calls.
56.15 over the next 24 hours That's only about 4.5%
Still
above
like
the
that.
share price,
Still.
right outside of that 1 standard deviation.
1
move
cent
that the
off,
option
not bad.
market's pricing in. Call volume about 4 times
Not
normal
bad.
daily average volume that we've seen over the last week of trading. So, yeah, you know, expectations really low in this one.
Yeah.
I would not be surprised if they come out with a decent report, maybe some decent guidance.
Sure.
That the consumer's still strong, especially the
You would
affluent
think.
one.
Yeah, and the corporate consumer.
You could
and-
easily see the stock get up.
Guess I could have
5,
called
10.
20K.
That's the distinction of this trade from the other two, is that this is short-term, 24
Well,
hours
earnings play.
Earnings play.
Time to
Where the
review.
others are a little bit more like synthetic long positions,
Yes.
basically. All right, thanks, Tom, for the trades. Interesting stuff. When we come back, let's talk
I forgot
commodities
what
and
went
the
wrong
effect of
today.
the dollar that continues to
Kinda
show
whipsaw
up
a little bit
soft,
again.
even on days when yields are spiking.
Could have gone much worse with that
Gino gives
crazy
an
move on
update
Powell.
an auto parts stock you may not know about. It's getting smoked.
I didn't get
after
stopped on that.
earnings.
That would
We
give
got
me a nice
plenty ahead.
cushion.
20 minutes till the bell.
I was going in to cancel the stop and well, I hadn't filled, but it wouldn't let me cancel because it's pending. I don't know. Shouldn't have had that big of a. Well, it's yeah. I was a bit surprised by the volatility actually from that event. Thought it'd be kind of big, but that was surprising, especially that first drop was really criminal. Just complete stop loss hunt for no reason. Cool. Call him. You only have all in. End of day. Got to do it. 4, 5. You had a pair of 4s. You jerk. Over that high card. Okay, I'm done with that. Today's red day again. Interesting. 2 in a row. I was kind of trying to wait for J Powell this morning. So it was pretty slow to trade. However, I did get one trade in. I got calls. 5 at 9:51. So right there. 5 calls. Realized we were chopping to close them out at 10:03. So took a loss there. Bought calls again at 11:25. So wow, that wasn't a bad pickup right there. 5 calls there. Sold one at 11:28. Still looked like we were in a chop, so I was pretty scared. Bought 6 more calls at 11:29. So I realized I shouldn't have closed those there. Interesting, I'm still so red today on these trades. Sold 2 at 11:33 for a loss. I guess because my average. I guess. No, it might have been a gain. Light gain because my average was okay. Sold 1 at 11:35. Right at VWAP. Sold another one at 11:35. Sold one at 11:50. Nice exit there. And then put the stop loss in for the last 5. This is actually what kind of screwed me. Should have canceled it. I really should have. Going into cancel and I was just too late. The thing is he wasn't speaking yet. Or maybe he was, but we didn't have a feed of it. The stream hadn't started on either CNBC or Fed Reserve. And this was even before. Yeah, this was. Yeah, anyways, that candle, boom, and then boom. Just in a few seconds. So, my fill price was 246 on those. Wait. no, my stop, I was trying to have it stop at 260. And my cost basis, I can't really tell. I think that was just over my cost basis a little bit. So I had a stop at 260. It filled at 246. So I imagine that was somewhere down here in the bottom of this candle. Closed the rest. So all those nice ones I gathered up in here. Close them down here for a pretty big loss. What? 14 cents a contract. So yeah, that kind of sucked. But still okay. I was also trading. We'll go over the other account too. I had one trade on 2 other accounts. This is just the one account I'm going over right now. Then let's see, 1229. I bought a call. Back testing VWAP, which that was kind of a test actually, which I closed at 1249. Why did I wait so long? Oh, back to VWAP. That was a small loss on that one. No, actually, that was a gain. Interesting. Bought 5 puts at 114. The stop thing is that messed me up. I mean, those contracts would have been pretty nice. Let's see, 114. I know better than that too. I guess I wasn't expecting that volatile of a move. And then when I realized that maybe it could be, that's when I was going to cancel and it was too late. One of those things. Puts here. 5 of them. Got kind of scared though. Because I didn't have much conviction, which is never a good thing to enter, so maybe I shouldn't have. It was breaking a channel, had a little head and shoulders. It was rejecting, getting resistance on the top of this one, which I pulled from, I think, down here. Bought 5 more puts at 115. Did it back to back, I guess. And then sold 4 for a loss, a small loss at 123. Not sure how that was a loss. I'm saying the premiums today were weird. This was after Powell, I think. This was super strange that was a loss. Then stopped out of 6 of them. What's going on here at 125? How I stop out of them there, I don't know. That was for a gain though. No, it wasn't. It was for a loss. I don't know what was going on with the. I think. I don't understand what happened there, because those should all have been gains. Yeah, that's too bad, because I had literally had puts at the top. It was just still choppy and not great, clear, concise direction. So this probably would have stopped me out if I had stopped, but yeah, that's too bad, because that was a nice. Okay, and then about 10 calls at 131. Right here. Oh, that was a pretty big L too. Sold them at 135. I held on to those too long. It was for the break of this channel, which once it came back down, I should have just sold them immediately. I didn't have a stop on them. I manually stopped out, which I need to get back to doing that, putting a stop loss, an actual stop loss. I've been just kind of sitting on it until it's green and then selling 1 or 2 and then at the money. Yeah. Let's see. Thing is, if the chart. Like doing it that way. I haven't had good success doing that way either. I gotta just manually stop myself sooner or start putting in actual stop losses for a loss. Not break even. Yeah, so stopped out myself out there. Bought to open Bought puts again, 10 puts at 215. Oh yeah, right here, channel breaks. This whipsawed me, unfortunately. Right here on that channel break, bought puts, 10. The premium from here to here was huge. I bought them for 152. I sold them for 128. 217. Like 1 minute, 2 minutes later. I don't know what was going on with premiums today. And then bought calls, 218. Right here. This channel was further down, I think, before. There's another one here. Because it broke it. Bought calls. Close them out at 222. These were I was trying to hold on to longer because I just gotten whipped out of that one. So I'm like, I'll give it a little time to breathe before it can break to the upside. And so, yeah. Anyways, right here I closed those on that channel break. So then, of course, I didn't feel like getting back into puts after it broke back down below there, which would have been a pretty good trade again. But there's no pattern. It was just a break of the channel, which isn't the best. But yeah, yep, mental exhaustion. You gotta quit. 254. I was into calls right here. Best trade of the day right there. I'll hold the one for sold one at 258 here. Sold another one at 305 right here, and then sold the rest for a loss at 310. And bought 12 calls at 330. Right here. Sold 2 at 335 right here. Stopped out of the rest. 339. Right there. That was the one account. Stops. The thing is though, is if I just should not have stops. Could have taken a little more profit before the volatile event and then gotten rid of the stops. But if this was all downside, then I would have wanted the stops. However, typically even if it goes down a bunch, you're gonna get a rally. But this candle was, I mean, that was ridiculous. That was, yeah. Yeah. It was really that candle limit, because I would have had a nice buffer. Mentally, emotionally, I would have been better set up if I was already sitting on a pretty good gain from selling some here or wherever. I would have been probably ready to be more patient and not trying to revenge trade or get gains back. Starts to snowball, you gotta be careful. And on the other account, I bought a call at 1124. So yeah, same time as that one. That was a great trade. I just got wrecked on the stop. And this one actually I sold at 12, so that was a nice little green trade. Did I sell it or I get stopped out? No, I got stopped on that one. Yep. Took a loss and got stopped. Tiny loss, got stopped on that candle. Would have been a nice trade. That one was up 50-60%. The one account that I didn't put a stop on, I had one contract though on these smaller accounts. I bought at 1124, same time. Actually, that one I got the soonest. And never had a stop. And I sold it at 1222. Right here. So that was like a perfect trade. And that one was 350%. So those all could have been, well, that was a daily. These other ones were next day, so they wouldn't have been that much, but those probably would have at least been 100%. So yeah. All right. Got tomorrow. Not trying to trade back what I've lost today. Gonna be patient, wait for a setup that I like. Thankfully, I don't think we have crazy volatility tomorrow. I'm gonna expect chop, and I'll expect a red day for myself. And then maybe, just maybe, I'll have the discipline to go slow, wait for a good setup. If I don't see one, don't take it. On the longer term, it's not looking like we're gonna hit the top of this channel. So, and we didn't really get a bounce back even today for me to get into. I was hoping for a VWAP to get into longer dated puts. I got out of most of them here, kind of back where we are now. Given there's almost a month of decay on it that I avoided, which is nice, but I don't know. I think we can still get a rally tomorrow. And to bounce the top of this channel. I'm not giving up on a Santa rally. Do we have a sell-off before then? Chart doesn't look bullish. Really doesn't. SPY's down 0.75. 5-minute finger slap coming in. SPY did chop into close. Good call. Bubba. AMC is up 2%. GME's down 4.8 at 13.18. Netflix held its gains all day. What a crazy balance in the market. Netflix doing this and Tesla down almost 10. Value's up. AT&T's up 6.9. Friday back to that level, whatever level that is. 20 cents. Ace, your buyer at 0. Nice. It's the perfect plan. It's only upside from there. Yeah.
And like you brought that up because we were talking about that earlier too. With the fact that the yen remains so soft despite all their efforts right
Tesla
now.
feel
There's
like
kind of a lot of odd stuff taking place in markets. When does odd turn to panic, Randy? How long can odd be?
No, there's still a little more gap down there. Maybe filled one of the gaps. There's another one, 208.
The high end of what we've seen since we broke down through 20 back in the spring, because that was a big deal.
Yeah, most of the concern in the spring up until June 1st was based on that debt ceiling concern. Once we got past that, we dropped below 20 and we stayed there literally for a couple of months. And it's only just 2 weeks ago that we went back up to that level. 20 is that threshold between normal range, and now all of a sudden people are getting a little bit uncertain. Now, I don't call it anxiety. We get into the high anxiety zone when you hit 30, but right now we're definitely on the cusp of that uncertainty zone, which means there's a lot of people out there who just don't know where we're headed. I think as we started Q4 and I was in this group, I thought we were poised for a very solid rebound in the markets, and I actually thought that was going to happen. All of my indicators were telling me that, and then that was right before the war in Israel began, and that tempered that dramatically. So last week, all we got was a modest upturn. I just don't think we can get any momentum going until some of these issues get resolved. And right now, what the VIX is telling us is that people are getting a little bit uncomfortable. Not panicked yet by
thanks for hanging out, man.
But certainly on that threshold of starting to get uncomfortable. So I don't know what happens from here. Like I said, we've got earnings. That's definitely working in our favor. When you look at the results so far, and we're only about 16% of the way through the reporting season, but the results so far are way better than they were last quarter, and they're way better than the expectations. So maybe another week or two of that. By the end of next week, we should be at about 30% or so. So that'll give us a good feel for how the season's going to play out. But I'm just not sure if earnings alone is enough. Now, maybe, again, as I said earlier, if we get a Speaker of the House in place, if we can get another continuing resolution or something to ensure that the government stays open for at least a few months, then that'll alleviate some of the stress. But you've still got the wars going on. You've still got concerns about inflation. You've still got high crude prices. All of those issues are going to continue to weigh and keep this from getting too far ahead. And frankly, that just means mostly sideways markets the way I see it.
So far, that's been the way we've held up. Every time it gets hit, we managed to find support in the NASDAQ around that 14,700, even the S&Ps. Still at levels that we've been familiar with very recently, but a little closer to the lows. So we definitely got to keep our eyes on that volatility. Appreciate it, guys. Thanks, Randy Frederick, Michelle Gibley. Good chat here on definitely an odd day. I think we all agree on that. We started the show describing it as a bit odd and finishing it as a bit odd. Let's go to where we have clear facts. We'll talk some of the big earnings when we come back, close out this session.
I was born on the south side of Chicago.
There's the bell. Thanks, IQ Up. I'm gonna keep working, keep chilling, keep the stream on.
Including but not limited to the Fed chair getting escorted off the stage in the middle of his testimony today. So, I mean, this is a weird one.
Yeah, it's been a wild day. You've seen that back and forth action over that unchanged line again and again, and it really shows that the market sometimes is searching for direction. It's battling a few things. It's battling high rates that we haven't seen since 2007. At the same time, there's still folks holding up this market. And you have people like Tom Lee, who spent his entire career on Wall Street as JP Morgan's chief strategist, saying it's during those frightening times that the best opportunities appear. And so, whether or not people will step in. And at the same time, I had one guest today talking about a 50% sell-off in equities. Russell Stone was saying something like that. So you have those that are in the doom and gloom camp, and others that think, you'll have some volatility and then some sort of Santa Claus rally. So I feel like we have to go back and forth. And what will the Fed do or not do? Because it does take time for that Fed policy impact on the economy, on these markets that we're seeing as well. It's got to go through it. So I just feel like we're in this wait and see mode, and we're getting mixed earnings and mixed economic reports. So I guess we do have to wait and see.
Yeah, you can kind of pick a side and spin it the way you want. If you're a doomer, worried and likes to panic over geopolitics, if you're a perma-bull like Mr. Lee generally, I mean, you can kind of spin it either way. Earnings being an example, where you could go to these numbers, like Randy just told us, that are coming in better than the last quarter, significantly, Scott, but still for a lot of key groups, they're not showing much growth at all. You're happy to basically get single digit on a sector-wide basis at this point, even if you are positive. So maybe time is our friend here.
Yeah, it may be, but we definitely know that we need that to be a little better than single-digit increases. Here's the other thing to consider too, right? The earnings are coming in great, sure, but compared to what? Compared to the estimates. Now, the estimates have also been adjusted, taking into consideration all of the things that have been going on, and so we've got a lot. I agree with Nicole. There's a lot of stuff going on here that we need to pay attention to, that we need to be, I don't know if concerned is the word that I would use, but a lot of traders and investors definitely are. Lately, for example, worries about oversupply of treasuries have gotten worse. The breakout of the war between Israel and Hamas definitely adds to that risk, particularly if the war spreads. President Biden has indicated that he will ask for $100 billion in emergency funds in coming days to support Israel, Ukraine, Taiwan, as well as maybe bolster the U.S. border security. So, all of these things are going to be adding to the oversupply that we're seeing in treasuries. As long as we have that, and here's one thing that Powell mentioned earlier today. He said, what? The yields and the rates are doing some of our work for us. Well, that's great. That continues. We will definitely have to take into stride earnings, and we'll have to consider what they mean exactly and compared to what and how they compare. But all things considered, the market still wants to go up. We almost hit 5 on the yield today. We didn't, but we almost did, and that 5 yield is acting as a big-time magnet still. So let's see what happens. Let's see what happens, but it's important for us to consider all that.
Does kind of seem like a magnet in inevitability. The other thing, too, is just that, we're never going to get too far. Even though we tried to rally today, Nicole, you're never going to get far when Tesla's down 10%. To me, it's kind of like I said earlier this week, it's like, look, I love doing the macro sleuthing as much as anybody. I think I'm a smart guy, but I've got a pretty simple strategy. It's called just do whatever Tesla does.
We've had that. We've had follow the semis, right? As the semis went, so went the market. As some of these magnificent sevens, so went the market. And big names like Tesla can move the market one way or another. And when you have Elon Musk coming on with such a cautionary tone on an analyst call, and some said the most cautionary they've heard in years, and concerns about margins. But I'll tell you, the guests I had on today, Hatem Diab and Steve Wesley, who used to be a former board member at Tesla, they both still said buy Tesla. I mean, they couldn't say enough about the big picture, the long term. There's frustration about the cyber truck and the 18 months that's taking, but the big picture was that
it's still on schedule.
Still the leader, and it's still breaking records, and still maybe we're underestimating the power walls for the home and the gigapacks for utilities and such. So there still is this sort of clear winning mentality for those that were bullish on Tesla in the first place. They still seem to be bullish. Yeah, maybe they have to slow down that bull a little, but that's the case.
I think there's also a really interesting takeaway from it too, which is that even though the stock market didn't reward Tesla because of the margin contraction, we're really seeing that in an economy unsupported by rate cuts and fresh stimulus, there is a sort of gnashing of teeth that happens, a separation of wheat from chaff, Scott, where Tesla's numbers, I feel like this quarter was the most definitive competitive leadership Tesla maybe has ever shown. Because even though they suicided their own margins, they still put out better margins than Ford and GM did last quarter. And their numbers are going to come out in a couple weeks, and they're going to be significantly worse too. So I don't think their margins are going to go up. So Tesla sold off on an earnings that probably showed loud and clear that they've completely cemented their leadership, with perhaps the exception of the Cybertruck.
Yeah, and isn't that about the ugliest truck you've ever seen? But,
I am the beholder.
Yeah, you got that right, I guess. Coming from a cowboy, that is probably
you're
going
a one
to be
horsepower type of guy.
Yeah, that's exactly right. But you're 100% accurate, and it will be interesting to see as the automakers come out with their earnings how they compare. There's probably just not a chance that they're going to be nearly as strong as Tesla. Especially now, we've seen the talk, for example, of GM. They're going to dial back their EV production. They've sold very few in comparison to Tesla, and maybe even some of the other EV companies. So I think you're 100% accurate. But, again, there is so much unstable footing in the market that, we can't underplay, or we can't discount completely the effects of the economy and what's going to happen. We have a lousy economy, and it doesn't really matter what happens with Tesla. True. Now, having said that though, many will say, well, maybe Tesla is the economy, and I think that may be some of what we're alluding to here. Not the economy, but the market for sure.
Yeah, that's kind of where I fall back on, where oftentimes it is the leading indicator of which way risk is going. All right, Nicole, close this out. We got 60 seconds left. Give me a last thought from New York.
Look, I love what Netflix did. Great for Netflix. You had one down, one soaring. I think my final thought is that I just don't love when the headlines, when I'm anchoring the show, and you have this too. I'm sitting here anchoring the show, and I get these headlines. Some are old, some are new. There's been attacks on Iraq and Syria on U.S. Personnel. And so drone rockets attack Iraq air base. The Pentagon stands ready and will take necessary action to protect its troops after attacks on U.S. personnel in Iraq and Syria. They're standing ready to go into Gaza. And these are the kinds of headlines. And we can look at the rates all we want, Oliver, but that these are sort of sitting here on our shoulders ready to come in. And you see the markets pull back, and you see oil move higher. I watch them cross here on the Thinkorswim, and I see the direct, maybe just a little tick, and usually 5 days later it's all knee-jerk reactions, but it's enough to bring worry to the market.
No, it's absolutely a factor, and it seems like in the end of the day it did show up, to your point, with crude, gold too, so it is quite a mixed pot.
The show between 2 and 3.
Yeah, good call. All right, appreciate it, guys. Thanks for the discussion, helping us figure out Nicole Petalese and Scott Durfee. When we come back, time for an overlooked stock. George Tillis will be joining us to discuss a mover that you missed, and it's far from squeaky clean. WD-40 got wrecked today.
Yeah, so kind of as I expected. I wasn't certain though. But yeah, my insurance is the reason why my mortgage went up 44%. I mean, there's no way. Like, you can't expect someone to pay that. You got to prove for a certain price on a home, and then to increase by 44%. It's like I didn't have a 44% buffer on my mortgage. That's insane. Anyways, yeah, I'm squaring that away. SPY, big drop today, down 0.8%. I mean, it looks bearish, but it could still chop and make its way back up. I guess shorter time frames will be more telling. No RSI divergence, not a whole lot really. Looking like it wants to at least find this bottom channel again before moving up. There. Five days still over the 20. We're closing today below the midline of the Bollinger on the daily, so could still see a bounce. I think Bollinger's really tightening up here. Yeah, I wanted to wait till the top of this channel to start scaling into puts. Trying to be patient on that. Anyways, that's it for today, guys. That was pretty exciting with J Powell. Holy smokes! I don't know what I'm gonna do. I don't know. That's yeah, it's outrageous. Yeah, so my insurance itself increased 125%. So I'm like, oh, I should have bought a house that's worth 44% more. I had no idea I could afford this. Thanks, guys. Thanks for really encouraging me to afford more. This is great. I don't know. We'll figure it out. Thanks, guys. We'll see you on Discord. See you tomorrow. And yeah, thanks for the support today. Appreciate all the likes. Okay, have a good afternoon. Peace.